Namaskar, hello and welcome friends to Finavision, your one-stop solution for CFA exams. My name is Shushmita Aditya Mukherjee. I'm in the profession of finance and into AI engineering. I provide solutions for my clients and I teach students to become professionally capable. This video is part of the full class series for CFA Level 3 curriculum. Let's get started.
So friends, welcome to this new chapter of option strategies. From option strategies, what do we understand, friends? From option strategies, we are trying to understand how an investor can combine different options to take positions based on his or her own projections of the markets or of some underlying, right? So, a good way to start this is start from the put call parity equation. So let's say there is a put option with a strike price of X and a maturity of time T and a premium of P0, and there is a call option of again maturity time T, strike price X and premium C0, and these two options are on the same underlying which has a current price of S0, right? Now the put call parity equation tells us that, let me write it down, the put call parity equation tells us that S0 plus P0 is equal to C0 plus present value of X with respect to the time to maturity of the options. Right? Here R is the risk-free rate, right? So, how can we interpret this equation? One way to interpret this equation is to take these variables as cash flows. So there is a plus S0, right? Plus S0, which means there is a cash inflow equivalent to the price of the underlying. So we can interpret this as shorting of the stock or shorting of the underlying. Then there is a plus P0, which means selling of the put, right? Because if one sells the put or shorts the put or writes the put, there is an inflow of premium as cash flow. This is equal to again plus C0, which means selling of the call or shorting of the call or writing of the call option, plus present value of the strike, which means there is a cash inflow. We interpret this as borrowing. Now friends, this equation can be used to create synthetic short position in the underlying, to create long position in the underlying synthetically, to create synthetic puts, synthetic calls, and also positions synthetically. So how do we do that? Let's take an example. Let's say we want to create a synthetic long the underlying. Long S0. How do we do that? We simply try to understand what is the synthetic position of a cash outflow due to purchase of the underlying. Because when we are long underlying, we are purchasing it. So there is a cash outflow, means we are trying to interpret what is minus S0 in this put call parity equation. Minus S0 will be equal to P0 minus C0 minus present value of the strike of the options. Right? Again, the options have the same strike X and the same maturity T, and premiums of the put option and call option are P0 and C0 respectively, right? These are our. Now here on the left hand side, what we have is a long stock, right? Long stock. So let me write here long the underlying or long the stock. This is equal to, there is a plus P0 here, right? So plus P0 means selling of the put. There is a minus C0 here, which means buying a call. And there is a minus present value of the strike, which means there is lending. There is a cash outflow equivalent to the present value of the strike. So there is lending. We interpret it as lending. Right? So sell a put, buy a call and lend. This is how synthetic position for long stock happens. Then how to create a short stock? Let's see. Short stock. A short stock means there is cash inflow. So plus S0. Plus S0 is equal to minus P0 plus C0 plus present value of the strike. We're just using the put call parity equation to synthesize our positions here, right? Now this can be again interpreted similarly that we did in the previous occasion. So plus S0 means there is shorting of the stock. This is equal to minus P0 means buy put cash outflow of the equivalent to the premium. So there is buying of the put plus C0 plus C0. So there is selling of the call and plus present value of the strike. So there is borrowing. So buy put and sell call and borrow. This is how the synthetic short position in the underlying is taken, right? Now apart from the put call parity equation, we also have put call forward parity equation. Let's see how that is. The put call forward parity equation goes like this. Present value of the forward contract. The forward contract here is maturing in time t and R is again the risk free rate, right? Plus the put premium is equal to the call premium plus the present value of the strike. Now here only the S0 has been replaced by the present value of the forward contract. Now this also can be interpreted in terms of the cash flows, right? Now one difference with respect to the put call parity equation that we have to understand here is in case of forward contracts, there is no upfront cash inflow or outflow. Cash inflow or outflow happens only at the maturity, right? In case of put call parity equation, it is the upfront cash inflow or outflow which is balanced with respect to the lending or borrowing. But here there is no upfront cash inflow or outflow. Therefore, the lending or borrowing part need not be considered while creating synthetic positions. Because there is no upfront cash inflow or outflow, the initial balancing through borrowing and lending is not required to be considered because it is inbuilt within the equation, right? So here, how would we create a long forward position or a short forward position? That is a long forward contract or a short forward contract. Let's see. A long forward contract means there is going to be a cash outflow at time t, which means right now we calculate the negative of the present value of the forward contract, right? So 1 plus r to the power t. The present value of the negative cash flow. This is what we consider. This is equal to, as per the put call parity equation, this is equal to P0 minus C0. The borrowing or the lending part we are not considering here because there is no upfront cash inflow or outflow in the put call forward parity equation, right? Now again, like we did before, we are going to interpret this equation in terms of cash flows. Let's see how that works. Minus F0 by 1 plus r to the power t. This means there is a buying of the forward contract or long forward, right? This is equal to plus P0 minus C0, which means there is a premium inflow due to the put option, which means there is selling of the put, and there is minus C0, which means there is buying of the call. By buying the call, there is a cash outflow equivalent to the premium of the call. So minus C0 means there is buying of the call. So long forward synthetically can be created by selling the put and buying the call. Selling the put and buying the call, right? Then how to create short forward contract? Short forward contract means there is a cash inflow. So we say plus present value of the forward contract plus F0 divided by 1 plus R to the power T. This is equal to C0 minus P0. Right? So there is a plus C0 and there is a minus C0, which means plus C0 means there is selling of the call and minus P0 means there is buying of the put. So these two together form the synthetic position, which is equivalent to short forward contract.
A gentle reminder in between the classes, if you need support in your CFA exam preparations, if you want to know how these concepts are applied practically by professionals, and if you want to learn artificial intelligence and its application in finance, check out the link below. Now back to the classes.
So friends, now in this section we'll discuss about synthetic options. So we'll try to understand how to synthetically create a long call, a short call, a long put and a short put. And the basis for our understanding will be again the put call parity equation and the put call forward parity equation. So let's get started. First is synthetic long call. How can we create a synthetic long call? Now to understand this, let's start with the put call parity equation. Now what can we understand from the put call parity equation? From the put call parity equation, we can understand that shorting a stock plus selling a put is equal to selling a call and borrowing the amount which is equal to the present value of the strike price of both the put and the call option, right? And these options, put and call options, have the same strike X and the same expiry capital T. And therefore the discounting is done with respect to 1 plus R to the power T, where R is the risk-free rate, right? So here the borrowing has happened on a risk-free basis. Now from this, if we have to rearrange the equation to find out the synthetic combination which gives us a long call, what do we need to do? We need to separate out minus C0 because that represents a long call cash flow. When you buy a call, you pay the premium, which means minus the premium of the call, which is C0. So minus C0, the value of this according to this equation is equal to minus S0 minus P0 plus present value of the strike, right? So this is a long call, and to create it synthetically, what we have to do according to this equation, we need to buy the stock because there is a minus S0 here, which means cash outflow. We have to buy the put. Minus P0 means we have to pay the premium, so buy the put, and plus present value of strike price means we need to borrow. Borrow, buy the stock, buy the put. This is the combination which creates a long call according to the put call parity equation. Now we can also derive a synthetic long call from the put call forward parity equation. Let's see how that works out. So from the put call forward parity equation, what do we understand? Present value of the forward contract plus the put is equal to call plus the borrowed amount, right? Now here every sign is positive, which means there is a shorting of the forward contract, there is shorting of the put or selling of the put, there is selling of the call, and there is borrowing, right? Now the difference between the put call parity equation and the put call forward parity equation is an upfront cash flow due to the underlying. In the put call parity equation, we either buy the stock or sell it. That is, we buy or short it. So there is an initial cash inflow or outflow. And along with that, there is an upfront borrowing or lending, right? Upfront borrowing or lending. Now, in case of a forward contract, there is no upfront cash flow. The cash flow only happens at the end of the contract term. So there is no upfront cash flow in this case, which means the borrowing or lending amount here is also not upfront. It can be ignored. It is within this forward contract. It is incorporated within this forward contract. Unlike the put call parity equation, here it is incorporated within the forward contract. So this means when we are creating synthetic positions out of the put call forward parity equation, we can ignore the borrowing or lending amount, this portion, because there is no cash inflow or outflow due to the forward contract upfront. At t is equal to 0, there is no cash inflow or outflow, right? So we can ignore the borrowing or lending amount also. So now from this we can understand that the minus C0 is equal to minus the present value of the forward contract minus P0, right? So this means a long call is equivalent to buying a forward contract and buying a put, right? Here the borrowing or lending amount is ignored. So we can write it here. A long call is equal to buy the underlying or buy the stock. Let me write underlying here. And buy the put and borrow. Alternatively, it can also be synthesized with respect to a forward contract where you buy the forward contract or long the forward contract and you buy the put or go long the put, right? This is the way the synthetic long call is created, and we can also derive all the other synthetic option positions. So let's look at the synthetic short call now. Let us do one thing. Let us copy the forward parity equation, the put call parity equation and the put call forward parity equation once again here. Okay. Short call is equal to, there is a cash inflow of the call premium. So plus C0, right? Plus C0, cash inflow. So this is equal to, plus C0 is equal to S0 plus P0 minus the present value of the strike, right? Which means if you have to understand this expression, this basically means there is an inflow due to the underlying, which means short the underlying. Short the stock or the underlying. Then there is an inflow due to the put option. So short the put or sell the put. And there is a cash outflow minus present value of the strike, which means lend. Right? And in terms of put call forward parity equation, plus C0 can again be written as plus C0 is equal to forward present value of the forward contract plus the put option premium. So this simply means there is a cash inflow due to the forward contract, which means short the forward contract, and there is a cash inflow due to the put option, which means short the put option or sell the put option. So we can again write it. Short call is equal to short this underlying in our case, in our example, it was stock. It is basically short the underlying plus short the put plus lend. This is equal to short the forward plus short the put. Again, we ignore the borrowing or lending part because there are no initial cash flows in case of a put call forward parity equation, right? So this is how it goes. Now, the third thing that we'll look at is synthetic long put. So let's look at that. So a synthetic long put means there is a cash outflow of the put premium, means we are trying to understand what is the synthetic combination which creates minus P0, right? So minus P0 is equal to S0 minus C0 minus present value of the strike, right? So here, if we have to interpret this, cash outflow due to the put, which means long put, is equal to cash inflow due to the underlying on the stock, which means short the stock, cash outflow due to the call, which means buy the call or go long the call, cash outflow due to the present value of the strike, which means lend, right? Now, according to the put call forward parity equation, we can again create a minus P0. This is equal to present value of the forward contract. Actually, here there is a plus sign, right? In case of S0 also, in this case, there is a plus sign. So, I am writing it in both cases. 1 plus R to the power T minus C0. So, this simply means long put is equal to cash inflow due to the forward contract, which means short the forward contract, and cash outflow due to the call option, which means buy or go long the call option. The borrowing or lending amount, as we have said before, it is going to be ignored in case of put call forward parity equation because there is no upfront cash flow happening here. Now, let me write it. Long put is equal to short the underlying plus long the call or buy the call plus lend, which is again equal to short the forward contract plus buy the call or long the call, right? And we can easily create these positions if we have the put call parity equation and put call forward parity equation. Now the fourth position that we are going to create is the short put, synthetic short put. So let's do that. Synthetic short put. Short put means there is a cash inflow of the put premium, which means plus P0. Plus P0 is equal to minus S0 plus C0 plus the present value of the strike. This we can again interpret there is a cash outflow due to the underlying, which means buy the stock or buy the underlying, sell the call, and borrow, right? Borrow means there is a cash inflow, right? So here there is a short put. Similarly, in case of the put call forward parity equation, plus P0 is equal to minus the present value of the forward contract plus C0, which means long the forward contract or buy the forward contract and sell the call or short the call, right? Now we can again write this short put. This is short put, right? So short put is equal to buy the stock, sell the call, and borrow. Buy the underlying plus sell the call and ball. This is also equal to long the forward contract or buy the forward contract. Long and buy mean the same, sell and short mean the same, plus sell the call. Buy the forward and sell the call, right? So we have created the long call, short call, long put and short put positions. Now we'll move into the next section. Now friends, this new section we are recording in a new day, so a very good day to you. So we'll start with a simple option strategy which is called a covered call, right? Now what is a covered call? A covered call is basically buying the underlying asset and selling a call on the same underlying asset. Let me explain what we are talking about here. So let's say at t is equal to 0, an investor buys an asset. The price of the asset at that time, let's say, is S0. And at the same time, the same investor sells a call at a premium C0, right? The strike price of this call is, let's say, X. Now, what can be this strike price? This strike price can be at the money, can be in the money, can be out of money also. Now, this depends on the outlook of the investor and depending on the objectives of the investor. Generally, why the investor is trying to buy a call? Generally, why an investor wants to get into a covered call is because of certain reasons such as return enhancement, risk reduction, selling at a target price, selling at a price that is suitable for the investor, etc., etc. So we'll discuss the targets in a very short while. First, let us discuss the mathematics behind a covered call. What are the calculations? What is the maximum profit? What is the break-even price? What are the costs? What is the value at the end of the expiry of the call option? All these things let us discuss first. So as we said, this strike price, if anyone is having a question that what should be the ideal strike price. Now instead of T0, let me write T is equal to 0 here. At initiation, T is equal to 0, right? Now, for example, let's say at T is equal to 0, the investor buys the stock at $100 and sells a call at $100. This means two things. One is the investor believes that the stock is going to remain flat, that is, there will be very low volatility. And second is there is maximum premium earning in this kind of a setup, because at the money options have the highest premium. So this will be earning the investor the maximum premium. So this can be the objective of an at the money covered call, right? The second option is out of money covered call. What is out of money covered call? Out of money means the strike price is above the current stock price, right? So let's say the price is 110. Now here also there is premium income. There is high premium income and the investor is cautious. The investor is cautious and the investor keeps a scope of earning from capital gains also, right? So there is premium income and capital gains income from this. Then there can be a in the money covered call, which means you sell the call below the strike price. Let's say $90. In this case also there is premium income, not as high as ATM, but there is premium income and at the same time caution can be maintained. Caution in terms of twofold. One thing is, even if the stock goes down to a certain extent, the option does not get exercised. That is one form of caution. And second thing is, the investor maybe wants to take advantage of the volatility. That also can be the case, right? So depends on the objectives of the investor what is going to be the strike price. Now, let me remove the rough work and move into our previous example itself. So we have our strike price at X. Stock underlying is S0 at T0 and premium earned is plus C0, right? And for the stock, the payment amount is S0 at T is equal to 0. So this is the cash flow, minus S0 which is for the underlying and plus C0 which is for selling the call of the underlying. Now the option, let's say, expires at T is equal to capital T, and at capital T the price of the stock, let's say, is capital S capital T. Now for the option, the ST will decide what will be the cash flow. So the cash flow will be defined like this: maximum of either 0 or ST minus X. And this will be a cash outflow, so negative, right? Because the call has been sold. So this will be a cash outflow if the option is exercised. If it is not exercised, obviously there will be the value of the option will be 0. Now, we take different scenarios and try to understand what is the maximum gain, what is the maximum loss, what is the break-even price, what is the expiry value, and what is the profit or loss at expiry, right? So let's go one by one. Initially, the net cash is plus C0 minus S0, right? This is the net cash flow at t is equal to 0. And at expiry, t is equal to capital T, the net cash flow is plus ST, assuming that the stock is sold, minus max of 0 or ST minus X, depending on whether the stock price is above the strike price or not. Therefore, the value of this option at expiry is nothing but this cash flow amount, right? ST minus max of 0 ST minus X. This is the value at expiry. So let me write it down. Expiration value is equal to ST minus max of 0 or ST minus X. This is the cash flow, possible cash flow or 0 cash flow for the option. Now coming to the profit or loss. Profit or loss is basically the initial cash flow and the final cash flow combined. So this means, let's say this is the initial cash flow C0 minus S0, initial value, initial cash flow, and the final cash flow or the cash flow at expiry or the expiry value, this is EV, right? So profit and loss or profit or loss will be basically initial value plus expiry value cash flows. This is equal to nothing but C0 minus S0 plus ST minus max of either 0 or ST minus X, right? This is the profit or loss at expiry at time t, right? So let me write it down in one single row here. This is the profit or loss at expiry, and expiry value we have already written down here. Now the question comes, what is the break-even price, what is the max loss, and what is the max gain? Now what is the break-even price? Now the break-even price is basically exactly the reverse of the initial cash flows. So the initial cash flow, initial value or initial cash flow was equal to plus C0 minus S0. The reverse of this cash flow, if that is equal to the price which is happening at the expiry, that means if ST is equal to S0 minus C0, which is just a reverse of the initial value, in this situation there will be a break even. So the reverse of the initial cash flow is equal to the break even price. So break even price, let me write here, S0 minus C0. Now what is the maximum loss? This is another question. Maximum loss happens when the stock price goes down to 0. When the stock price goes down to 0. Let me write down here. The profit or loss is given as C0 minus S0 plus ST minus max of 0 or ST minus X, right? Now let's say at expiry the stock turns to 0. What happens? Firstly, ST becomes 0, so the stock has become worthless, and secondly, this option has also become 0, which means it is not exercised. So in this case what happens is the actual cash flow remains at C0 minus S0. So if you sold the call and earned 3 rupees or $3 premium, and the asset price was $100, so your net cash outflow becomes minus $97. Now this is the worst case scenario, right? So the maximum loss happens when the net value at the end of the expiry is C0 minus S0. So let me write it down. Max loss is equal to C0 minus S0. This happens when the stock becomes worthless. ST is equal to 0. This is the worst case scenario, right? Then what is the maximum gain? Let's understand that. So the maximum gain happens when the stock reaches exactly the strike price. Let's see how. At the expiry, the stock price reaches X. This means the option does not get exercised because it's max of 0 or 0, which means the option value remains 0. Only a plus X gets added to the cash flows. So this is the maximum cash flow, which is equal to C0 minus S0 plus X. So let me write it down. Max gain is equal to C0 minus S0 plus X. So this happens when ST is equal to X. Remember, this happens when the price at the expiry of the option, the price of the underlying becomes equal to the exercise price. So we have covered the major points that needed to be covered here. Now friends, we will be discussing the investment objectives behind a covered call. The first obvious objective is yield enhancement. So let's say the call premium is 3% or 5% or whatever, and there can be two scenarios. Either the spot price at the expiry is not greater than the strike price, so it is less than or equal to the strike price. In this case, the option does not get exercised and there is an extra premium earned, 3% or 5% or whatever is the premium percentage. That extra yield is earned through this selling of the call. And the second option can be, let's say ST was actually greater than X, but it was not enough to cover the premium cost, right? So let's say the stock price only increased 2% compared to the strike price, but the premium was, let's say, 3% or 5%. In this case also, the option does not get exercised. In this case also, there is a premium to be earned, right? So there is premium earning here. Now, the next option is reduction of position at a favorable price. Let me remove the rough work here. Reduction of position at a favorable price. What do we mean by this? So let's say maybe 3 years back somebody bought a stock at $10 and right now the price has reached, let's say, $100. Now the investor might be thinking that the markets are in a late expansion stage and the investor wants to cover for downside. So let's say the investor sells at this point, sells a call at $95. So that is the way in which reduction of position at a favorable price can be done, and this is done, it can be done in long term also, it can be done in short term also. In the short term, we generally call it target price realization. So yield enhancement, reduction of position at a favorable price, target price realization. Then risk reduction. Obviously, when somebody is selling a call on the same underlying that one is buying, one is trying to protect the downside. So this is risk reduction also. One can reduce delta through this, for example. For example, a portfolio has a delta of close to 1, 0.98, and they want to be much more market neutral because of the market scenarios. They sell partial covered call and they reduce that delta to 0.5 or 0.3. This can also be done, right? This is called risk reduction. Now we have been speaking about call premiums and put premiums, basically option premiums. So what does an option premium comprise of? It basically comprises of two things. One is time value and the second is intrinsic value. Time value and intrinsic value make up the total call premium. Now how do we calculate time value and intrinsic value? This is done by the help of Greeks. Now these Greeks will be discussing right now. Now another strategy which is very closely associated with covered calls is the protective puts. Let us discuss this once. So here, let's say at t is equal to 0, at the initial stage, an investor buys a stock which is priced at S0, and at the same time, the investor buys a put which has a premium of P0, right? So there is a cash outflow minus S0 and there is a cash outflow minus P0 also through purchase of the put on the same underlying. and the strike price of this put obviously depends on the outlook of the investor. Now, let's say at the expiry, T is equal to capital T, the spot price becomes S capital T, and obviously the value of the option at expiry is maximum of either 0 or strike price minus the spot price at expiry, right? So we can design here the cash flows at the initial stage and at the final stage, or the values at the initial stage and the final stage, right? So here the initial cash flow is minus S0 minus P0, and the expiry stage cash flow is plus ST considering the stock is sold plus max of 0 or X minus ST. The first one is the initial cash flow or initial value, and the second one is the value at expiry or the cash flow at expiry, right? Now from these two we can easily find out what is the value at expiry. We have already written that, and what is the profit at expiry, also break-even price, max loss and max gain. Let's do them one by one. So here the expiration value is equal to ST plus max of 0 comma X minus ST, whichever is greater. And here remember we are writing here plus max of 0 X minus ST because the option has been purchased. The option has been purchased. If it was sold, it would have been minus max of 0 X minus ST, like in covered calls, right? And the profit or loss is basically the sum of the cash flows. So initial value or initial cash flow plus final value or value at expiration or cash flow at expiration. This is equal to, let me write it down here, minus S0 minus P0, it's a capital S, plus ST plus max of 0 and X minus ST, right? Now the obvious question that comes is, okay, let me put another bracket here. Now here the obvious question is, how do we measure the maximum gain, maximum loss and break-even prices? So let's start again with the break-even price. The initial cash flow was minus S0 minus P0, right? Now if the final price is just the reverse of it, that is plus S0 plus P0, if this is the price at expiry, then this becomes the break-even price, right? So break-even price is equal to S0 plus P0, which is nothing but equal to the price at expiry of the underlying. Now comes the question, what is the maximum loss and what is the maximum gain? To understand that, let me write down the profit or loss value at the expiry. So this is equal to minus S0 minus P0 plus ST plus max of either 0 or X minus ST. Now here the initial cash flows have already happened, right? Now let us consider three scenarios. One scenario is when ST is greater than X. This is scenario 1. In this case, what happens to the option? The option expires without value. ST remains ST. So the cash flow becomes minus S0 minus P0 plus ST, right? This is scenario 1. Now let's consider scenario 2. Let me remove the rough work here, or let me reposition the break-even price here. Let me take a scenario 2 where ST is less than the strike price. This is scenario 2. In this case, what happens? In this case, the option has a value. The option has a value, and what is the value? That is X minus ST, right? The price of the stock obviously is ST. So the entire cash flow becomes basically ST and ST cancel out, and the cash flow becomes X minus S0 minus P0, right? Let me take a third scenario where ST is exactly equal to X. This is a third scenario. In this case, what happens, friends? In this case, let me rub it here. In this case, what happens is the option again expires without value. ST becomes equal to X. So the net cash flow remains the same, plus X minus S0 minus P0. And if you look at all the options, here this is plus ST minus S0 minus P0, right? So ST is greater than X. This ST that I am circling here, this is greater than the strike price. So here this is not the maximum loss. The maximum loss can be this one, X minus S0 minus P0. This one is the maximum loss. So let me write down the maximum loss here. This is equal to X minus S0 minus P0. Now what is the maximum profit? Maximum profit happens when ST is greater than X. It can be little greater than X or it can be much greater than X, right? The gain can be unlimited actually. So higher the ST is, if it is greater than X, what happens is this option expires without any value. So this becomes 0. This remains ST and the net cash flow is ST minus S0 minus P0, right? ST minus S0 minus P0. So the higher the ST is, the greater the gain is, and theoretically it is unlimited. So we can write the maximum gain here. This is equal to ST minus S0 minus P0, which is practically unlimited. And this happens at what position? When the spot price at expiry is greater than or much greater than X, right? It is greater than X or much greater than X. These two criteria. Second is, when does maximum loss happen? This happens when the spot price at expiry is less than or equal to the strike price. So that's how this happens, right? Now we'll discuss what are the investment objectives of covered calls. So the primary objective of a covered call is loss protection or upside preservation. So let's say an investor has bought a stock at S0 and the investor is concerned that the price may go down. What that investor can do is buy an ATM put. In that case, any amount of downside is protected. In fact, any price below S0 plus P0 is protected here, right? So this is one way. Second thing is upside preservation. Now, in the covered call, one was selling a call, which means one was getting into the obligation side of the option. Here, one is buying the option. One is buying the put option, which means the downside is covered, but upside does not necessarily yield losses or cash outflows. So it's a right, not an obligation. When the stock moves upwards, the value of the option becomes 0. It does not become negative. But when it moves downwards, it becomes positive. So there is upside preservation. There is no loss of upside, but there is a protection on the downside, which means there is obviously risk reduction. Now this reduction at a portfolio level or at an investment level can be partial or full. So let's say a delta of a portfolio is 0.75. One can use a protective put to reduce it to, let's say, 0.65 or 0.5 or 0.4 or whatever, right? So this is what we mean by notional count of shares going down. Once one buys the put, the delta of the portfolio goes down. If the portfolio has only stocks, then the delta of the portfolio is 1 without any derivatives. But if one gets into derivatives like buying protective put, then it starts to come down. It can come down to 0.8, 0.7, 0.5, 0.4, whatever degree of reduction in delta is required, that can be attained by getting into a protective put. Now we'll move into the Greeks that we were discussing. Option Greeks. So what are option Greeks? Option Greeks are basically certain parameters based on which the valuation of an option depends on, right? So we will discuss them one by one: delta, gamma, theta, vega and rho. These are the 5 major parameters on which the value of an option depends. Now what do these mean? One by one we will discuss. Let's start. First, let us talk about delta. What is a delta? Delta is basically the rate of change of value of an option with the change in price of a stock. Rate of change of value of an option with respect to the change in price of a stock, and it is given by the sign also, which is delta, right? Now an option exactly behaves like a stock when the price of the option and the strike price are absolutely matching with each other. So let's say the strike price is X. This is the strike price of the option, and the possible values of the underlying stock price are represented by this line. So this is on either side of X, right? Now this axis is represented by different values of the underlying, or S. S is equal to X at this point, right? Now the value of the delta depends on the probability of the option expiring in the money. The probability of the option expiring in the money. What do we mean by that? Let's say the strike price of an option is $100 and the stock is right now at $100, right? Now what is the probability that it will go either this way, that is in the negative way, lower than $100, or higher than $100? The probability here considered is to be half, right? When it is at the strike price, the probability of it going upwards or downwards is same. So the probability of it expiring in the money, is 0.5. And this is the starting delta and this is the starting value of delta at strike price. So delta at strike price is equal to 0.5. Now there is a positive sign and negative sign to this delta value also. We'll get into that in a while. Right now let's say we are only considering a call option. That is, when it goes upwards of the strike price, the probability increases, right? Now the value of the delta can be plus 0.5 also, minus 0.5 also, and in fact close to plus 1 and minus 1 also. It depends on which kind of option you have bought. Here we have taken the example of a call option, which means in the money means the stock price has gone above the strike price. So we are considering a delta positive. In case of a call, it is delta positive. So let me write XC here. Delta at strike price of a call option is equal to plus 0.5. Let me also write the sign here. Plus 0.5, right? Now let's say the price of the stock moves and it moves to 125. Price of the stock is 125. Now what is the probability that it will expire in the money? It is much more closer to 1, right? The probability of this option ending within the money is much more closer to 1, right? So delta of a call option which is in the money call option is equal to or nearby 1. 1 means it behaves much like the stock. As much as the stock changes, that much the value changes. When the probability increases a lot, close to 1, then the delta changes almost as much as the stock changes. So if the stock value changes by $5, the value of the option also changes close to $5. If the stock value changes by $10, the value of this option also changes by $10. Closely, right? Now let us take an opposite scenario. Let's say the price has gone down and it has gone down to $80. Now what is the probability that this will end in the money? The probability has come much closer to 0, friends. Probability of in the money for this call option is much closer to 0, and that is exactly how the delta also behaves. The delta of an out of the money call option is almost equal to 0. At the money it is 0.5, deeply in the money it is 1, and deeply out of money it is 0. So if you have to draw a curve like this, it will be something like this. Let me write it here. So the delta of a call option moves something like this. So we are writing here, please remember this is delta of a call. Now all these other Greeks we'll discuss later. First let us complete the delta part. Delta of a call. When it is deeply out of money, the delta value is 0. Like if I write the values here, let me draw the axis here. Let's say 1 is here, 0.5 is here, and 0 is at the base of the axis, right? Now delta will move something like this. Let me draw it here. Deeply out of money, it will be very close to 0. And then slowly it will keep on moving up because the probability of in the money increases. So it will move up, move up, move up. And at the strike price, it will be 0.5. And as the price moves beyond the strike, that is it gets in the money, it will go on the other side, that is it will become plus 0.6, plus 0.7 like this. And when it is deeply in the money, it will be almost like 1. And this is how it will work. So this will be almost like 1. So this will be almost like 1. Approaching 1. And deeply out of money, it approaches 0. Right? Ideally speaking. So this is much like a sigmoid curve. If you have done machine learning or artificial intelligence, you will understand. This is much like this looks much like a sigmoid curve. Now, what about a put option? We'll understand the put option now. For that, let us for now remove these other Greeks. We'll explain them in other slides. Okay. So this is what we have discussed, this entire part. This is basically delta of a call option, right? So let me write it down. This is given by del V del S. Now what about a put option? In case of a put option, friends, when the stock price increases, the value of the put option goes down. When the stock price increases, the value of the put option down. And that's why a negative sign is incorporated. Let me write it down here. Delta of a put, the magnitude behaves very much similarly, but a negative sign gets incorporated. This is how it behaves, right? Because when the stock is moving up, the value of the put is going down. Now let me once again draw the price axis. This is the price axis, and in the middle lies the strike price. S is equal to X, and the vertical axis is denoting the values of the delta, right? So here it is strike price. Now here something different happens in terms of the value. The base of the delta of a put is -1. So here the value is -1, not 0, friends, it is -1. At the top it is 0. So in case of a call delta, it was from 0 to 1. In case of a put delta, it is 0 to -1 on the other side. That's why. So in the middle, it is -0.5. Right? At the top, it is 0. These are the delta values for a put option. Now, friends, let's understand. When the stock price, let's say it was 100, strike price was 100, the price of the stock was also 100. At this time, the stock moving up and moving down, what is the probability? It is 0.5 on either side, right? So the point would be here. I am drawing the red dot here, you can see. So now if the stock moves downwards, this side, the probability of the put being in the money goes up, right? As it goes deeper in the money, it goes closer to 1, right? Let's say the price of the stock has gone down to, from 100 it has gone down to 60 or 70, let's say $70. At that point it is very close to 1, right? But because it is inversely related to the value of the stock, we put a minus sign. We say, we do not write 1 here, we say it is close to -1. So the curve moves something like this. So as the option keeps on moving in the money, the curve moves towards a value close to -1, right? it moves very close to -1. And let's say on the other hand, the stock price moves upwards of the strike price. In that case, the probability of the stock being in the money diminishes. It becomes very, very close to 0. So in that case, what happens is the curve moves towards 0. The curve slowly moves towards 0. And this one is also a sigmoid curve. Now the put delta curve also looks exactly the same, but only thing, it behaves in the inverse way. That is, it goes from 0 to -1 and -1 to 0. At the money for both is 0.5 in magnitude, but in case of put it is -0.5, right? So let me write down here delta of a put which is at the money has a value of -0.5. Delta of a put which is in the money, deeply in the money, this is a value which is very close to -1. And delta of a put which is deeply out of money, delta of a put which is deeply out of money, this is a value which is very close to 0. And this is how the delta behaves. Delta is a linear variable and it behaves in this way, right? Now, like in science we heard about velocity and also we learnt about acceleration. Here also there is something which is of that order, and that Greek is called gamma. We will discuss that now. Now we come to the second Greek, which is gamma. Now what do we mean by this gamma? Gamma is basically the rate of change of delta with respect to price of a stock. Now what do we mean by that? Let me do one thing. Let me draw the graph of delta here to better understand what is gamma. So this is the delta curve. Please do not mistake it to be the gamma curve. This is the delta curve, right? Now here, what can you see the characteristic is? Now when we talk about gamma, we are actually talking about rate of change of delta with respect to the price. So let me write gamma here. Gamma is equal to rate of change of delta with respect to the price, right? Or we can write it as a second derivative of the value of an option. So this is equal to del 2v del s2, right? This is a second derivative of the change of value of an option, or the rate of change of value of an option with respect to price, right? So what do we mean by this? Let's say the strike price of an option is $100, okay? Now the delta of the option, it's a call option by the way, the delta of the option is equal to 0.5 when S is equal to $100, right? Because at $100 going up and going down, we consider that probability of both is equal. So this is a probabilistic representation. Delta, you have to remember, this is a probabilistic representation of the option with respect to the stock. So at the strike price, both ways is equally possible. So the value of the delta is 0.5, right? Now let's say the price of the stock moves to $105. Now at $105, the probability of the option expiring in the money has increased a lot. So here the delta of the call has increased, let's say to 0.70. Initially it was 0.50 at the money. As the price increased, it became 0.70, right? Now the price increased further. It increased from 105 to let's say $110. Okay, this increased further. Now the delta of the option is let's say 0.8. It increases further. How much does it increase? Let's say the price of the stocks goes to $150. And at 150, let's say the option delta is equal to 0.90. Right? So you can see a clear trajectory here playing out. So you can see clearly that as the price increases above the strike price, the probability increases of the option expiring in the money, and the delta therefore also increases and goes nearby 1, almost to 1, 0.9, right? But one more thing, if you look carefully, you'll observe. The first $5 when the stock changed, for the $5 the change was 20 points, right? Change was 20 points. The next $5, it was 10 points, right? The next $40, it was 10 points. So the rate of change, as the probability becomes more and more sure, the rate of change of delta diminishes. The speed of change of delta, that diminishes. And this speed of change is being denoted by the Greek gamma. This speed of change is denoted by the Greek gamma. Basically, graphically speaking, gamma is the slope of delta. Gamma is the slope of delta. Let me define it. The slope of delta when the stock is somewhere here, $150, as I was saying, I'm writing in green here, you can see here. When it is $150, it is almost 1, but the slope is flat, it is 0. That means gamma here is almost equal to 0. As the price moves closer towards the strike price, the gamma keeps on increasing. Increases a little bit here, right? Increases just a little bit here. You can say gamma is like 0.1 maybe. Increases a lot more here. Increases much more here. You can say gamma increases much more here, right? Let's say, for example, it is 0.3 here. And the gamma is maximum just at the middle when the stock price is just passing across either side of the strike price. There the gamma is maximum. So the maximum point is at the strike price for the gamma. For the delta, it is in the money. For the gamma, it is at the strike price where the value is maximum. And remember, rate of change is always positive in magnitude. For a call delta also it is positive in value. For a put delta also it is positive in value. Rate of change does not have a negative value because it is always increasing when the price is approaching the strike price. And it is always decreasing when the price is approaching away, going away from the strike price. So it looks something like this, much like a bell curve, you can say. So if I have to draw the curve, if I have to draw the axis, here are the price ranges and the strike price is somewhere here. And the gamma, denoted by the green curve, is maximum when the strike price is approaching. And again, as the stock price keeps moving away from the strike price, the gamma diminishes, right? This is how it is. Here do not take into note the kurtosis and all that here. The curve here is hand drawn, so do not take into account all those things. But ballpark, we can remember that as the price approaches strike price, gamma keeps on increasing, and as it diverts away from the strike price, gamma keeps on decreasing. This is both for put and call, right? And gamma is always positive. So can you go negative gamma? The question is, can you go negative gamma? The answer is yes. If you short an option, you can go negative gamma. But if you are long an option, you are always positive gamma. So let me write it down. So friends, two of the Greeks we have understood, delta and gamma. What are left? We have three more left, theta, vega and rho. We will understand them one by one. Let's start with theta. Now friends, here one interesting thing we can understand. This gamma curve looks more like a normal distribution, right? This looks more like a normal probability distribution, right? Or you can call it the probability distribution function. And with respect to this, the delta curve looks more like a cumulative distribution function of a normal distribution, right? This one looks like the cumulative distribution of a normal distribution PDF. Now, if you are having a little bit of question that what is a CDF and a PDF, PDF is basically the general normal distribution that we see. Now, if you stack up the values of the normal distribution across the axis, that is, let's say one value is here, one value is here, one is here, one is here, one is here, one is here. Like this, if you stack up the values, you get a curve which looks like this. And ultimately, it may start from 0 and end at 1. Because all the probabilities, slowly as you add up every probability, all the probabilities get included, right? And as a result, initially the cumulative probability is 0, but as all other probabilities or all other probable options get added, the probability keeps on increasing and proceeds towards 1. And that is how delta also functions. And the gamma functions like a PDF, right? Now this will be handy when we try to correlate the option premium with respect to the Greeks. It is not fully part of our syllabus, but having a mathematical overview of it will help having a clearer idea of things, right? So now we'll move into the other Greeks starting from theta. So theta is also known as time decay. Now what do we mean by time decay, friends? Now an option has 1 hour to expire. An option has 1 hour to expire. What are the probabilities that its moneyness is going to change? Nearly 0, right? Nearly 0. Probability of change of its moneyness is 0. Almost 0. If it is 1 minute, again, probability of change is almost 0. Now I am writing delta here, don't confuse it. This is change. 1 second, even closer to 0, right? But if it is 3 months, then the probabilities are much higher, right? The probabilities are much higher. If it is 1 year, it is much higher, right? This is what is represented by theta. Basically, theta is written like this: change in value with respect to change in time. This amount, change in value with respect to change in time, this amount is defined as theta. And this is also probabilistic. This is a probabilistic basis to it, because now as time approaches expiry, the value approaches 0. And this value approaches much faster if it is an ATM option. If it is a in the money option, it approaches a little bit more slowly. Let me write it down. Let's say the strike price is $100 for an option, and the underlying also has a price of $100. So this is an ATM option, right? This is an ATM option. Now how will the curve look like? The vertical axis, let that represent the value of the option or the option premium, right? Value of the option. And the horizontal axis, let it represent the time. Now here the curve will look something like this for the ATM option. This curve moves down very, very steep near the time of expiry, which is given by capital T, let's say. Now what if the option is in the money? Let's say the option is in the money. In the money means, let's say it's a call option, okay? It's a call option, and right now the stock price is $110. This will have a lesser slope. It will look something like this. This will have a lesser slope. So this is the in the money option. In the money option situation. And remember, we are assuming that the price remains constant. Now let's say the price of the stock is kept at $90. So this is an out of money option, right? Out of money option. Here the slope will be in between the in the money and at the money options. So it will look something like this. Why this is so? This is because irrespective of whether the option is out of money or in the money, the gamma is less compared to at the money. Gamma is maximum for at the money option. And that's why the time decay is maximum for an at the money option. At the money options have the highest time decay or the steepest time decay. And generally theta is negative because as the time is approaching expiry, the value is decreasing. So theta is negative. Now how can you go positive theta? If you short the option, you are positive theta. If you are long the option, you are negative theta. Because theta itself is negative in value. If you are long the option, you are negative theta. If you short the option, on the other hand, you become positive theta, right? So let me write this down also. This is similar to gamma. In case of gamma, we had to go short the gamma to go negative. Here it is reverse, right? So here long option means negative theta, short option means positive theta because the value of the theta itself is negative. Now, this is a simplistic understanding of what theta is. We have also had a simplistic understanding of what gamma is and what delta is. Next, we'll look at vega and rho. So friends, now we will discuss our fourth Greek, which is vega. Vega is basically change of value of an option with respect to the change in volatility. Let's see how the equation goes. Vega is given by the differential between the change in value of the option dv with respect to the change in value of the volatility d sigma. Sigma here is the volatility. Now friends, we have previously studied about Black-Scholes equation, right? Do we remember how the equation looked like? Let's try to redraft that once again. So let's say C is the call premium. This was given by, in terms of Black-Scholes equation, this was written as price of the underlying multiplied by ND1. This is basically the cumulative distribution function of the standardized probability of price change of the option, which is given by D1, minus strike price of the underlying multiplied by exponential term raised to the power minus risk-free rate into the expiry time of the option, time to expiry of the option, multiplied by again the cumulative distribution function of D2. Now D2 is basically D1 minus sigma into root over of capital T. Capital T is the time to expiry of the option, right? Now this is specifically, we are talking about European options, right? Those options which can only be exercised at the expiry. They cannot be exercised before expiry. Obviously, they can be marketed or sold in the secondary market or in the official exchange markets before expiry, but the exercise cannot happen before expiry, right? So we are talking about European options here. Now here the obvious question arises that we have written what is D2, but we do not know what is D1, right? We have not written what is D1 yet. So what is the expression for D1? If you can remember, the expression for D1 was given like this. Natural log of the ratio of the underlying price divided by the strike price plus the risk-free rate added with volatility square by 2 multiplied by T, this entire expression divided by sigma into root T, right? Now here this D1 is basically representing the probability of the price moving upwards, because here we are talking about a call. Here we are talking about, by D1 we are actually trying to express in mathematics what is the probabilistic or what is the probability scenario of the option ending in the money. D1 is trying to express what is the probability of the call option to be in the money when it expires, right? At any point, at any given point, when the time to expiry is capital T, the strike price is X, the stock price is capital S, the volatility is sigma, the risk-free interest rate is small r. These expressions combined together give the probabilistic understanding of the option ending in the money. This is simplistic understanding of D1, right? We are not diving into the depths of mathematics. We are just trying to understand what D1 stands for. Now here you can see, friends, we have taken volatility as a constant. in this entire equation of Black-Scholes, volatility is constant. Now the question obviously is, if volatility is assumed to be constant when we are trying to measure option premium through Black-Scholes equation, then what is the need for a Vega even, right? Now the answer to this is, through Vega we are trying to understand in case the volatility changes. In case the volatility changes, how will that affect the option premium or the option price? That is what we are trying to understand here, right? So Vega is giving you an idea, in case the volatility changes, what will be the change in value of the option premium, right? Now Vega is maximum when the option is at the money. And from then on either direction, whether it goes deep into the money or deep out of money, the Vega comes down. That is, the impact of change in volatility on the value of the option comes down as the stock's price move away from the strike price. So let me draw the chart here. The vertical axis is the Vega. The horizontal axis is the price of the stock. And let's say a particular point represents the strike price, point X, strike price. Here the Vega is maximum. So let me draw a vertical line here, dotted line, and the maximum value of the Vega will be here. Let's say the maximum value is somewhere here. And then it keeps on moving downwards. As the option moves deep into the money or deep out of the money, it moves downwards. And we have to remember that the minimum value is 0. That the minimum value is 0. Obviously, the Vega value is asymptotic. That is, it approaches 0, never reaches exactly to the value of 0. It approaches 0 as it moves deep into the money or deep out of money. But it is maxed out when the option is at the money, right? When it is at the money. Now the value is positive. This means Vega is a positive numeric. Now can one be negative Vega? Yes. If one writes an option or sells an option, then one can be negative Vega. Now when does Vega become most useful? Vega becomes most useful when there is an anticipation of change in volatility, or when the expiry, time to expiry of the option is way ahead, that is, there is a long time for expiry, or when someone is going through a strategy, or when someone is applying a strategy which does not involve direction, it only involves change in volatility, like a straddle. We will discuss straddle in a while. So this is the situation when Vega becomes most useful, and one obviously can go negative Vega, that is short Vega, when one sells an option or writes an option. Now we'll move into the last Greek, which is rho. Rho is nothing but the measure of the change in value of an option with respect to change in interest rates. So rho is equal to dV dr, where r is the interest rate, v is the value of the option. Now this rho becomes minimal in value when the time to expiry of the option is very, very less. But it becomes much more important in value when interest rate volatility is high, and also when the time to expiry is comparatively longer. These two conditions combined, rho becomes very, very interesting and rho becomes valuable. Now, here is a chart which represents the movement of rho with respect to the moneyness of the option and the expiry date of the option. And here in this chart we have assumed that the price of the underlying when we are creating the chart is $100, right? Now based on this, depending on the strike price of the calls and puts, the values of the rows are given here. Let's analyze them. Let's say the strike price is 80. To begin with, let's assume the strike price is 80. If the strike price is 80 for both call and put options, you can see here the put options are having a row value which is clustered around 0, very near to 0, right? The blue line represents 1 year to expiry. It has a value of somewhere around 8 or 8%, which means 0.08, right? It is nearer to 0. Then the red one represents a put option which is an expiry of half a year or 6 months. This has a value at this point which is equal to somewhere around 0.01 you can write, very near to 0. And the last one has actually just a little bit more than 1 month, and it is almost tending towards 0. This one is almost tending towards 0.0, right? Now, in the same manner, if you see the call options, the features are different. Just to be reminded, the row of puts ranges from -1 to 0, right? Ranges from -1 to 0. And -1 is for deep in the money options. Deep in the money options. And 0 is for at the money options. Similarly, the row of calls ranges from 0 to +1. And the +1 is for deep in the money options. And the 0 is for at the money options. Right? Now here, if the price of the underlying is 100 and the strike price is 80, all of the put options are out of money, but all the call options are deep in the money, irrespective of their expiry. And as you can see, the longest to expiry is the blue line, which is almost like 1 year or exactly 1 year to expiry. This is a value of excess of 60. So it is somewhere around 70, let's say. So this has a value of 0.70. The other one, this one, the red dotted line, this represents expiry of half a year, that is 6 months. This is a value of somewhere around 0.48, let's say. And the last one, which is 1 month to expiry, 1 month approximately to expiry, this is a value of somewhere around 0.8 positive, right? 0.08 positive. So you can see, even if all of them are deep in the money, one other feature is the time to expiry has a dominating effect here. Because the time to expiry is very minimal for this 1 month option, the value is closer to 0. Other ones which are 6 months to expiry and 1 year to expiry, they have much higher values. But those which are coming very close to the time of expiry, their values are reducing drastically. Their values are reducing drastically, right? Now let me take the opposite scenario. The opposite scenario means strike price of 120. I am rounding it here with green. Let's have a look at this one. Now 120 strike price means all these options that we are mentioning here, because the underlying price is at 100, irrespective of the time of expiry, all the put options are deep in the money, right? Therefore, you can see the 1 year to expiry, that is the blue line here, this has a value of in excess of 90, that is you can write here 0.92 or 94 here, right? 0.92. The next one, half a year to expiry, this is 1 year to expiry. The next one has a half a year to expiry, this is a value of somewhere around 0.5. And the last one, about 1 month to expiry, this is 1 month to expiry, this has a value of somewhere around 0.08 once again. So again you can see time to expiry is also having a very vital effect here. The row is being impacted by time to expiry and also by its moneyness. At the money option means row is closer to 0. Nearer to expiry means again row is closer to 0, right? So this is how row behaves. So friends, we have discussed all the Greeks here. We have discussed what is delta, we have discussed what is gamma, we have discussed what is theta, vega and rho. Now, is there a way to use all these Greeks to find out the premium of an option? There are no exact equations like this, but we can draft an approximate equation which tries to calculate the premium of an option. Obviously, this equation will not work when the changes in price are drastic or changes in volatility are drastic. Any of the parameters, if they change drastically, this equation will not stand, but there is an equation. Let's write it out. So the combined equation or the approximation equation goes like this. Change in value of an option is equal to change in value of the underlying multiplied by delta plus change in value of the underlying square multiplied by half into gamma plus change in time multiplied by theta plus change in volatility multiplied by vega plus change in interest rate multiplied by rho. Now this, let me remind you, this is an approximation equation. This does not hold when the changes in any of the parameters is very drastic. This is just to give a simplistic understanding that all these factors together are actually influencing the value of the option. Now friends, we will move into our option strategies once again. We have understood this equation just a little bit. Deeper understandings are beyond the scope of CFA syllabus, so we will not get into the deeper mathematics of it. So friends, as we already know, there are calls and puts. These two are the options, and one can buy them or write them. That is, one can buy them or sell them. Now, writing a call is basically an obligation to sell. It is an obligation to sell. Writing a put is an obligation to buy, right? On the other hand, buying a call and buying a put are not obligations, they are just rights. Buying a call is the right to buy at the strike price. Buying a put is the right to sell at the strike price. So when we are trying to write a put or a call, we are basically trying to earn a premium, and our speculation is that the option will not move against our speculative direction. That is, when we are writing a put, we expect the stock price to go up, or at least not go down to a stage where we have to buy the stock. Or even if the target is to buy the stock at a certain price, that is also a deliberate option. That is not an option where we did not know that okay, it's going to go down. So when we are writing a put, either we are trying to earn a premium and our speculation is the stock price is not going to come down beyond the strike price, or maybe we are predicting that the stock price may come down and we want to just reduce our buying price by writing a put and earning some premium. This can be the objective, two main objectives of writing a put. Similarly, writing a call might be earning a premium and thinking that the direction of the stock price will not move downwards below the strike price. That is one thing. And second thing is, okay, the stock price we are selling at a downward price and we are obligated to sell at a price, but along with the price we have an added income of the premium. So this is basically the approximate objective of writing puts and calls. Another objective of writing puts and calls can be play on volatility. These things we'll discuss later. On the other hand, buying a call and buying a put are basically attempts to have the right but not the obligation to buy or sell at the strike price. So there are multiple combinations that can be made by combining buying a call, buying a put, writing a call, writing a put. All these strategies, we'll look into it as we go ahead into this chapter. First, let us discuss one other strategy which is called a cash secured put. So what is a cash secured put? Cash secured put is basically you are writing a put, that is, you're earning a premium at time zero, and at the same time you are depositing a cash which is equivalent to the strike price of the option. So if the stock price moves upwards of the strike price, the option is not exercised, which means there is an earning of the premium. Then the objective to buy at a certain price. Let's say our objective was to buy at the price of X. So we write a put at X, and if the price falls up to X or below X, it does not matter. We buy at X because we are convenient with securing the price at X. And in addition to that, we actually end up earning a premium over and above, right? That is the second thing. Then, and as we said, like a certain reduction in the buying price. So when we are buying at X, we are actually also earning just a little bit of an income through the premium. Just a little bit of a reduction in the buying price. Reducing risk of short position in stocks. Now this can be done in two ways. One is buying a call option, and second is selling or writing a put option. Now which one to choose when? Now the put option, selling or writing the put option, this can be chosen when you expect the volatility to be low. But if you expect volatilities to be high, it is better to go for buying a call option. This is for the scenario where volatility is assumed to be high or going to increase, right? So friends, now we start with combination of options and related strategies. The strategies that we start with are bull spreads and bear spreads. Now what do we mean by a spread? A spread is basically a strategy in which the two different options are either both. A spread is basically a strategy where the difference of two option strike prices create the profitability. Let's say the two options are having a strike price of XL and XH. XL being the lower strike price and XH being the higher strike price. Now depending on the strategy of the spread, one can buy the lower strike price, one can sell the higher strike price, or one can do the reverse, which means one can sell the lower strike price and buy the higher strike price. It can be based on puts and calls both. Right? Now we will go into all those specific permutations and combinations later. First, we try to understand what is a spread. So when we are taking contrarian position in options, in same kind of options at two different strike prices, then what is happening is our profit margin is going to remain in between these two range. The risk is also lowered, but the profitability is also lowered in this case because we are taking contrarian decisions based on our speculative positions of the directional movement of the underlying stock. Now we will get into the specific strategies or the specific categories of the spread strategies and try to understand what are the possibilities in those strategies, right? So the first option is a bull call spread. Now what is a bull call spread? A bull call spread is basically a strategy where you buy low and you sell high. Which means you buy the lower strike price call and you sell the higher strike price call. So let me write here, you buy the lower strike price call and you sell the higher strike price call, right? Let's say at t is equal to 0, you are looking to get into a bull call spread. Let's say a stock is right now priced at $100. You think this price is going to go up till $110, right? Now what you do is you buy the lower strike price call. So you buy the call at 100 and you sell the higher strike price call, which is based on your speculative understanding of the direction. So you sell the higher strike price call, you sell a call at 110, right? Now these C100 and C110 are basically the premiums of the respective strike prices. So this is the initial cash flow, right? You have bought the call at 100 strike, so there is a cash outflow. You have paid the premium and you have sold the call at 110, which means there is a cash inflow. Obviously the cash outflow is higher because here the call is at the money and the premium at 110 is lower because it is out of money, right? Now in this kind of a scenario, we can seek different options and try to understand what is the profitability, right? So let's say at expiry, now let's say the ATM call has a premium of $6. So the cash flow is minus $6 and the OTM out of money call has a premium of $2. So there is a cash inflow of $2. So net cash flow is negative $4 or cash outflow of $4. This is at t is equal to 0, right? This is at t is equal to 0. We are right now discussing the bull call spread and we have started with the cash flows at t is equal to 0 and the strategy itself based on the speculations. Now at expiry, that is t is equal to capital T, let's say the price of the stock has reached $120, right? $120. Now both the options are in the money, right? So both of them are going to be exercised. Now the 100 strike option was bought. Therefore the cash outflow is plus of max 0 or 120 minus 100, right? This is the cash inflow and the cash outflow is of the sold option, that is minus max of 0 and 120 minus 110 because the 110 strike call option was sold. So this is the net cash outflow at t is equal to t, right? So this is equal to, you can easily understand, it is $20 minus $10, which is equal to plus $10. So at t is equal to capital T, there is a cash inflow of $10 and at t is equal to 0, there is a cash outflow of $4, right? So the net cash inflow is equal to 10 minus 4. 10 minus 4 is equal to plus $6 in this case, right? Now let's look at another scenario. Another scenario means another destination price for the stock at expiry. So at t is equal to capital T, let's say the stock price reaches $90. Instead of 120 or 110 or 115, it has gone in the reverse direction. It has gone down to $90. In this case, both the options expire without being exercised. So the net cash flow at t is equal to t is actually equal to 0. Cash flow at t is equal to 0, right? So the initial cash flow, that is cash flow at time 0, this is equal to minus $4, and this is what remains totally. So total cash outflow remains minus $4 plus 0, which is minus $4, right? Sum is equal to minus $4. Let's look at a third scenario. Let's say the stock price reaches $104. $104. At $104, what is the cash flow? Cash flow at time t is equal to, we bought the option at strike 100, right? So it is plus max of 0 and 104 minus 100. And we sold the 110 strike. So this is minus max of 0 and 104 minus 110. So the second option expires without being exercised, right? Because this is out of money at expiry. So the net cash at t is equal to 104 minus 100, which is plus $4, right? Now the net cash flow is equal to CF0, cash flow at time 0, plus cash flow at time t. So this is equal to minus 4 plus 4, or this is equal to 0. So here we have taken an example of a break-even price. Remember friends, this is one of the break-even prices, right? Now friends, we can actually take these scenarios. Now friends, we can actually take multiple of these scenarios to create max gain, max loss, break-even price, expiration value, profit and loss at expiry, right? So let's remove the rough work and generalize these scenarios, okay? Let me start with the value at expiration. Value at expiration is basically the net value between the option sold and the option bought. Now let's say we bought the option with the lower strike price XL. This one we bought. This is the buy. And XH, the higher strike price option, we have sold. So this is sell. Therefore, the expiration value is max of or plus max of 0, ST, which is the spot price at expiry, minus XL minus max of 0, ST minus XH. Because this one, the second one, the higher strike price one, we have sold. Now, at initiation, what was the cash flow? At initiation, the cash flow was buying the lower strike price option, that is minus CL, and selling the higher strike price option, which is plus CH, right? This is the cash flow at initiation. Therefore, if you add this cash flow with the expiration value, we get the profit or loss at time t, right? So profit or loss at time t is equal to plus max of 0, ST minus XL minus max of 0, ST minus XH minus CL plus CH. And remember, CL is greater than CH because CL is nearer to the money. You can say almost it is at the money, and CH is out of money, right? So CL is greater than CH. Please remember that. Now we'll get into the break-even price, max loss and max gain. What is the break-even price, friends? The break-even price is equal to strike price plus the difference of the premiums, which means this is plus CL minus CH. Let's see how this works out through our example. In our example, at t is equal to capital T, that is expiry, when the price was $104, the net cash flow the net cash flow was equal to 0, which means break even occurred. How did that occur? See, first part is 100, second part is 4. 100 was the lower strike and 4 was the difference between the premiums. One premium was 6 which went out, and other premium was 2 which went in. So the net cash flow was minus 4, which was balanced by this extra $4 above the strike price, right? So this is what is being represented in this formula. XL plus CL minus CH. This is the break-even price for bull call spread. Then maximum loss. When does maximum loss occur? Maximum loss occurs when the price remains at the lower strike price. So let's say in our example, if the price remained at $100, then both the options will expire without being exercised, and the net cash outflow will remain at minus $4. And this is the maximum loss that can occur, which means this is equal to CL minus CH. This is the maximum loss amount. Obviously, this is a cash net outflow. This will be a negative value. And maximum gain, when does this occur? Maximum gain occurs when the stock price exceeds the higher strike price at expiry, and the amount of maximum gain is equal to the difference between the strike prices minus the difference between the premiums. The difference between the strike prices minus the difference between the premium. Let's say in our example, the price reaches 120. In that case, the option that we bought at 100 will give us a return of 20, right? And the option that we sold at 110 will give us a negative return of minus 10. So the net return is 20 minus 10 or plus 10. But initially we had paid minus 4. So the cash net maximum gain is equal to plus 10 minus 4. This is equal to 6, plus 6. You can, instead of 120, you can verify it with 150 also, right? If it reaches 150, what happens? If it reaches 150, the option that we bought at 100 will give a return of plus 50, and the option that we sold at 110 will give us a return of minus 40, right? Now we can do the calculations, friends. Let me rub it out. The net cash flow again remains as plus 50 minus 40 minus 4. This is equal to 10 minus 4 or plus 6. And this is going to be valid no matter what the price is, as long as the price is above the strike price. So even if you choose a price of 111, let's say 111, it remains the same. The 100 strike option gives you a return of 11. The 110 strike option gives you a return of minus 1, right? Because this is the one you sold. Therefore, the net cash flow is 11 minus 1 11 minus 1 minus 4. This is equal to 6. So it remains the same no matter what is the price once it goes above the strike price, right? And not only above the strike price, even at 110, it will give the same result. At 110, this becomes 10 and this becomes plus 0. Therefore, the value becomes 10 minus 0 minus 4. This is equal to 6. So let me write it down here. This happens when the spot price at expiry goes above or equal to the higher strike price, right? And max loss is CL minus, this is negative, CL minus CH, this is negative, because CL is at the money and is higher than CH, right? Break even price occurs at the price of, this is a price, this is a price, this is ST. Now we have understood bull call spread. Now let us understand bull put spread. Now friends, we enter the bull put spread. Now there are certain differences here with bull call spread, friends. Although we are looking at increasing of the price towards getting gains, but the calculations are a bit different and the strategy positioning is also different. Let us see how. Let's say a stock is at a price of 100. and we are expecting that the stock price will go up. This is at time 0, S0, right? Now what we do is we sell the higher strike put and we buy the lower strike put. But here is the difference. The higher strike is near the money. Let's say perfectly at the money. It is at the money or near the money. And the lower strike in case of a put is out of money. In the previous case, the lower strike was at the money. CL was at 100. CH was out of money, right? This was 110. This was out of money. In case of puts, it's the reverse. In case of puts, it's the reverse. The process remains the same, but the position values are inversed, right? So again, we buy the lower, which means there is a cash outflow of minus PL and there is a cash inflow of plus PH. Now here, PH is greater than PL. PH is greater than PL, which means the net sum of this is greater than 0. There is a cash inflow. There is a cash inflow, right? This is a credit spread. You can say this is a credit spread. The bull call spread was a debit spread. You can say it was a debit spread because cash went out. Here it's a credit spread because cash comes in. Now, expiration value. What is the expiration value? This calculation remains the same. But a very important difference, friends. If right now the price is $100, you sell the put at $100 and you buy the put at 95 or 90 or 80 or whatever, right? Now, coming back. Expiration value. We bought the put at lower strike, max of 0 and XL minus ST. We bought the lower strike put and we sold the higher strike put. So this is minus max of 0 and XH minus ST, right? And initially the cash inflow was plus PH minus PL. So profit and loss at expiry is given by plus PH minus PL plus max of 0 or XL minus ST minus max of 0 XH minus ST. Now what is the maximum gain, maximum loss and break-even price? First, the maximum gain. This occurs when the spot price at expiry is greater than equal to the higher strike. This condition remains the same for both, for bull call spread, for bull put spread. In both the cases, this remains the same, right? And the amount, what is the amount? Amount is equal to difference between the premiums. Difference between the premiums. This is the maximum gain from a bull put spread. And what is the maximum loss, friends? Maximum loss occurs when the strike price at expiry goes below the lower strike. Goes below the lower strike, right? Here also, the maximum loss amount is given by difference between the spreads minus the difference between the premiums. Difference between the spreads minus the difference between the premiums. So here also there is a rule reversal, right? In case of bull call spread, if you remember, the maximum loss was difference between the premiums and the maximum gain was the difference between the spread between the strikes and the difference between the premiums. There is a role reversal here, complete role reversal here, you can see, right? What is the break-even price? Break-even price is equal to, here the calculation reference is the higher strike price. So break-even price is the higher strike price minus the difference in the premiums. Higher strike price minus the difference in the premiums. So this is how the bull put spread occurs. Now this will be only clearer when we do a few problem sets. So let's do that. Let's say the stock price is at 100 at t is equal to 0. And the option prices are like this. Strike price XL is equal to $100. Strike price XH is equal to $110. Premium for the lower strike call is let's say $6. Premium for the higher strike call is, let's say, $2. And premium for the lower strike put is, let's say, $8 and premium for the higher strike put is, let's say, $3. Now we have a few questions. The first question is how to create a bull call spread. The answer to this, what is the answer, friends? The answer is buy the low, sell the high. Buy the low, sell the high. In case of bull spread, you buy the low, you sell the high. So let me write it here. In case of bull spread, you buy the low, sell the high. Which means you buy CL and you sell CH. Buy the premium CL, sell the premium CH. Okay. Next question. What is the maximum gain in case of a bull call spread? And at what price or what minimum price can it occur? So what is the max gain in case of a bull call spread and what is the minimum price of ST for this to happen? The answer, friends, are you trying it with me? If you try it, you will actually recall this much better. In case of a bull call spread, or in case of a bull put spread also, the condition remains the same. The strike price has to be exceeded or at least equaled. The higher strike price has to be exceeded or equaled by the spot price at expiry. This is the condition. So the minimum price, ST minimum for maximum gain, is equal to, what is the highest strike price? This is $110, right? So ST minimum is $110, right? So we have answered the second part of the question first. Now we answered the first part of the question. What is the amount of maximum gain? Maximum gain amount is how much? So let's say at 110, what happens? At 110, two things happen. One is the higher strike option has a net value of 0. The lower strike option has a net value of 10 because this is 110 minus 100. So the net value at expiry is equal to $10. And the initial cash outflow was how much? The initial cash outflow at t is equal to 0 was equal to CL minus CH. This amount of outflow happened. So let me write it in negative. So this is equal to minus of 6 minus 2. You can see here the premiums. CL is 6, CH is 2. You can do it with me, friends. That will be the best way to understand this or recall this, right? Minus 6 plus 2. This is equal to minus $4. So maximum gain, as we have said, is equal to difference between the spreads net of the premium difference between the premiums, right? So this is equal to $10 minus $4, right? Because this $4 is basically a net cash outflow. So the maximum gain is $6. Let's say at t is equal to 0, the spot price of an underlying stock is $100, right? And we also have the premium numbers of a few options at certain strike prices. So what are they? Let's understand. Premium of a put option at 100. This is equal to, let's say, $8. Premium of a put option at 90. This is equal to, let's say, $3. Then premium of a call option at 100 is equal to, let's say, $6. Premium of a call option at 110. This is equal to, let's say, $2. Okay, these values we already have. Now, based on these informations, we have a few questions to answer. Now here the first question is, how do you design a bull put spread? The question is, how do you design a bull put spread? Now friends, in case of a bull spread, whether it's a bull call spread or a bull put spread, the theory is the same. You are banking on the stock going up, which means you are going to buy the lower strike and sell the higher strike. Here, what you are going to do? You are going to buy the lower strike. Lower strike means you are going to buy the P90. Buy P90 and sell the higher strike. Sell P100. This is a bull put spread. And you can see a difference between the bull put spread and the bull call spread here, friends. You will understand that better when we go into the further questions. Let's do it for now. So buy P90 and sell P100. Now once you buy P90 and sell P100, what is the cash outlay? So the second question is, what is the cash outlay at t is equal to 0? The answer is very simple, friends. You pay the premium for P90 minus P90 and you get the premium or receive the premium for P100, right? So this is equal to $8 minus $3, right friends? This is equal to plus $5. So you have a cash inflow of $5 in case of a bull put spread. And again, as we have said, this is a contrast between a bull call spread and a bull put spread, right? Third question, what is the break-even price for this bull put spread? What is the break-even price at expiry for the underlying for the bull put spread? If you do it with me, it helps in understanding much better. So you can do it with me, friends. So the bull put spread break-even price is equal to higher strike price minus the difference of the premiums. Higher strike price minus the difference of the premiums. This is equal to 100 minus 5 or 95. This is the break-even price. This is the break-even price at expiry. Okay. Now let's verify this. Now the price has reached 95 and you have sold the higher strike and you have bought the lower strike, right? Now from the lower strike, how much do you earn? The lower strike put, because this is a put, it is out of money, right? Why out of money? Because the price is 95 above the strike price and it's a put, so it is out of money, so you earn nothing. In case of the X100, it is in the money. The put is in the money. It's a put and it is in the money because the price 95 is lower than the strike. So the buyer of this put earns 5, which means you pay 5 minus 5. So you lose 5. Net you lose 5 when the price is 95. And initially how much did you earn? You earned plus 5. So the net cash flow is equal to plus 5 minus 5 is equal to 0. So here is your break-even price. Now the fourth question. How do you enter a bull call spread from the above information? Again, you buy low, you sell high. Answer. You buy low, which means buy X100 call. Here see, the lower strike is X100. The lower strike is X100, right? So you buy the X100 call by paying minus C100. Along with that, you sell the X110 call by receiving minus C110, which means a net cash inflow, which means a net cash outflow is equal to this plus, this is the minus 6 plus 2, which is equal to minus $4. So here there is a initial cash outflow, right? The next question. what is the break-even price? What is the break-even price at expiry? The answer is lower strike price plus the difference of the premiums. This is equal to 100 plus 4. Difference of the premiums is 4. So the strike price, so the spot price at expiry at which break-even occurs is $104. Let us verify it. 104 is the price at expiry. Now you bought the X100 call, right? And you sold the X110 call. Now the X110 call, this is a call, this is out of money, right? So this one expires without any value. But the X100 call, this is a call, this is in the money. This is in the money. So you earn 104 minus 100, which is $4. So your earning here is plus $4 at expiry. At initiation, the cash outlay was minus $4. So the net cash inflow or outflow is equal to minus 4 plus 4 is equal to 0. So we have our break-even price at 104, which is lower strike plus the difference of the premiums. The next question is, what is the maximum gain for the bull call spread and the bull put spread? Now friends, this question has two parts. First is, in case of a bull call spread, what is the max gain? Right? The condition is spot price has to reach at least the higher strike price, right? This means for the bull call spread, what is the value or profit or loss at T is equal to T? Profit or loss at capital T or expiry is equal to plus max of 0 ST minus XL minus max of 0 ST minus XH. We have sold the higher strike option and we have bought the lower strike option. This is what this equation is representing so far. And we also have to include the initial cash outlay, which is we sold the higher strike option. That means we received the premium, and we bought the lower strike option. That means we paid the premium. Now we can put in the values here. The value for the lower strike call is $6. If you can check it here, let me go back to the page. It is $6, right? You can see here it is $6, and for the low and for the higher strike it is $2, right? So let me write here. The higher strike, it is $2, and strike has at least reached the higher strike, which means ST should be greater than equal to 110, right? So if it is 110, the value of this bought option, this will be equal to 110 minus lower strike, which is 100, and for this one, the sold option, this will be 110 minus 110. So we can just plug in the values and write it here. This is equal to 110 minus 100, which is 10, minus 0, 110 minus 110, which is 0, plus 2 minus 6. This is equal to 10 minus 6 plus 2, $6, right? Now max gain that we defined was given by difference of the strikes minus difference of the premiums, right? This was the maximum gain, and this is equal to, again, 110 minus 100 is 10, minus difference of premium is 4. This is also equal to $6. You can do it manually. It is better to do it manually because remembering the formula can become difficult in exam centers also, but you may save time if you are able to remember the formula. In that case, you can use the second way, right? Now, the next part, in case of a bull put spread, the condition for max gain remains the same. It is higher strike price has to be the minimum price for the underlying at expiry. The higher strike price is equal to 100. In case of the bull put spread, it is equal to 100. So which means ST should be greater than equal to $100, right? And the lower strike price is 90, right? And the premiums, respective premiums, PH is equal to $8 and PL is equal to $3, right? Therefore, profit or loss at expiry is equal to, this is, we are considering it at $100, right? Because we are looking at a maximum gain condition. So this is equal to plus max of the lower strike put 0xl minus st minus max of the higher strike put. If you do it with me, it will be better to understand. Otherwise, if you just watch it, it might get a little confusing because we are using a lot of terminology here, which is actually complicated when you're listening, but when you're doing it, it's much easier. If you're practicing it, it is much easier. So it's better you can practice it a couple of times. So this is, again, we have bought the lower strike. So minus PL, we have sold the higher strike, plus PH. Now we know all these values, right? Minus PL means this is, PL is $3, so this is 3. PH is $8, so this is H. Minus max of XH minus ST. XH means this is 100 minus 100. Plus max of XL minus ST. This is, XL is 90 minus 100. So we can just put in the values here. The first one expires at 0 value. So this is 0 because negative and 0, the max value has to be taken. So the max value we take is 0. The next one also expires without value. So this is also plus 0. Minus 3 plus 8. This is equal to 5. So the difference between the premiums remains our maximum gain, right? As we have done in the theoretical exercises. Right, friends? Now we'll move into the bear, call and put spreads. So friends, we have learned what is a bull spread, right? Now the question is, we have to understand what is a bear spread. Now in a bear spread, we are actually trying to speculate that the price of a stock is going to go down. And based on the downward movement or a speculated downward movement, we want to make a profit. And obviously, like in bull spread, here also, in case of bear spread also, there are two kinds of spreads. One is a bear call spread and a bear put spread. Now let's say a stock is there which is at a price of $100, right? Now we want to get into a bear call spread. What do? We sell a call which is at the money. At the money we sell in case of a call, and we buy the higher strike call by OTM call. So in case of a bear call spread, we are selling the near the money or at the money call, and we are buying the higher strike call which is out of the money, right? And in case of a bear put spread, it is just the reverse. We are actually buying the ATM put. ATM put is being bought, and the lower strike, that is the out of the money put, somewhere here, let's say in case of the call, the higher strike is, let's say, $110, and in case of a put, let's say it is around $90, and we are selling this one. We are selling this out of the money put. So in case of a bear spread, we buy high and we sell low. In case of a bull spread, we buy low and we sell high. See, in case of a bear call spread, we are buying high 110 in case of a call and selling low 100 in case of a call. Same goes in case of a put. We are buying high, the ATM put, and we are selling low, the OTM put, right? So bear means buy high, sell low. Bull means buy low, sell high. And in that way, you are speculating on the direction of the stock price, and based on that, you are trying to make a profit on the position. Now, let's say at t is equal to 0, we are entering a bear call spread, and the stock price at t is equal to 0 is $100. Now here, in case of a bear spread, we are buying high and selling low. Now in case of a call spread, high means we are going to buy, let's say, $110 strike call, right? This call we buy, and the near the money or at the money call we sell. So we are going to sell a $100 call, let's say $100 strike call, right? This is what we are going to sell. This is at t is equal to 0, right? So the total transaction at t is equal to 0 is, we gain from the ATM call CL, lower strike call, and we lose from the higher strike or OTM call. Because the lower strike call is ATM, this is higher, this amount is higher. So here we have a positive cash flow. We have a positive cash flow, and we can call this as a credit spread. Bear call spread is a credit spread because of this. Now in case of a bear call spread, what are the profit and loss, expiration value, break-even price, max loss, max gain? Let's calculate them. Okay. So let's say now we are going to generalize. So let's say at expiration, the price of the stock is ST. ST. Okay. This means the expiration value will be max of this one is the one we bought, right? Max of 0 and ST minus X. So which one we bought? Which strike we bought? The lower or the higher? In case of a bear spread, we buy high. So this is XH. XH. Let me write it more clearly. And the one we sold has the lower strike. So this is minus max of 0 and ST minus XL. Right? This is the expiration value. And what is the profit and loss? This is the cash flow at expiry plus the cash flow at initiation. So this is equal to cash flow at 0 plus cash flow at expiry, right? Now this is equal to, we can easily write this, cash flow at 0 is plus CL minus CH, right? CL is the ATM call, so this is larger in value. So this is a positive value here. And the rest of the value is coming from the expiration value. So this is plus max of 0 ST minus XH minus max of 0 ST minus XL, right? This is the value at expiration. Now comes the question of what is the break-even price. Okay, so break-even price is basically nothing but the lower strike price plus the difference between the premiums. Difference between the premiums. So you can write it as XL plus CL minus CH, because CL is the higher value here, right? This is the break-even price, and this obviously happens at a price of ST is equal to XL. This is the price, remind you, this is the price of the stock at which break-even happens, right? Now, what is the maximum loss in this case? The maximum loss is equal to the difference between the strikes adjusted for the difference in premiums plus del C. Here del C is nothing but CL minus CH, because this is a cash inflow. This basically reduces the losses, right? So this is the maximum loss. What is the maximum gain? The maximum gain is equal to the difference between the premiums. This is equal to CL minus CH. Now, at what prices does the maximum loss and maximum gain happen? The maximum loss happens when the price goes above XH, that is the higher strike price. ST, when ST goes above or equal to higher strike price, that is when the maximum loss happens. And the maximum gain happens when the price fall at or below the lower strike price. Right? So we can see here, we are getting the maximum gain when the price of the stock is going down. We are losing the maximum when the price of the stock is going up. Now we'll come to bear put spread. So how is a bear put spread constructed? Let's look at that, friends. At t is equal to 0 or t0, let's say again the stock price is $100 and we want to get into a bear put spread because we are speculating that the stock price will fall. Therefore, we will do two things. We will buy an ATM put. We will buy an ATM put. Let me write it. We'll buy ATM or near the money put. And we will sell out of money put. Right? So here let's say at the money put means we are buying a put at a strike of $100 and we are selling a put of, let's say, $90 or $80, whatever it can be. Here in our example, it's $90, let's say. So we are buying high and selling low once again. But here the higher one is nearer to the money. The lower one is out of money, right? Because the current stock price is higher than $90. So this is out of money put that we are selling. Now here in this case, the value at expiration. What is the value at expiration, friends? Here we are buying the higher strike. So plus max 0 XH minus ST, ST being the price at expiry, minus we are selling the lower strike put. So max 0 XL minus ST. Rather than trying to memorize the max gain, max loss, break-even price, expiration value, profit and loss, it is better to understand how the processes are occurring so that you can actually calculate it yourself. We will get into the calculations again, but before, let us write down the profit and loss first. Now the profit and loss is the initial cash flow plus the final cash flow, that is CF0 plus CFT. What are the values? Initial cash flow is cash flow from selling the lower put plus PL minus PH, that is cash flow from buying the higher put. Here PH is higher. So here a bear put spread is the debit spread. This one is the debit spread, right? Plus PL minus PH, this is the initial cash flow. CF0 plus the value at expiration, this is the final cash flow, right? So let me write it down. Now what is the break-even price for a bear put spread? Obviously it is always somewhere between the two strike prices, right? So in this case the price is higher strike price minus the difference in premiums, and difference in premiums means it is the cash outflow, right? So actually we can write it here plus of PL minus PH, right? Because this is a negative value, this is a negative cash outflow, we can write it like this. Now max loss. What is the max loss? Maximum loss happens when the price is at or above XH. Now at or above XH, what are the valuations? Let's have a look at that. Plus PL minus PH, this remains the same. Then we will look at the expiration cash flows. Max of 0 XH minus ST. Now this expires out of value, right? Because ST is above XH. So this is 0 plus 0. And XL minus ST, this one also expires out of value. So this is also 0 plus 0 minus 0. So the maximum loss is basically the difference between the premiums, PL minus PH, right? Then this is the way we do the calculations. We did it manually here. The next one also we will be doing manually. Maximum gain. Maximum gain happens when the price has fallen at or below XL. At or below XL, right? So in this case, again, there is plus PL minus PH. The initial cash flows are there as it is. It is a cash outflow, by the way. And XH minus ST, this expires within value. So this is plus XH minus ST. XL minus ST, this also remains within value. So this is minus XL plus ST. So ST and ST cancel out and we are left with the difference between the strikes and the difference between the premiums. So let me rewrite this. This is XH minus XL minus PH minus PL, or you can write it in this way also, XH minus XL plus PL minus PH, right? Both ways you can write it, doesn't matter. This difference between the strikes and difference between the premiums. Here the difference between the premiums is negative, so we are putting a negative sign and altering the signs here, right? Here PH minus PL. right? Because this is going out, because we are selling the lower one and buying the higher one. Now this is about it for bear spread and bull spread. We will move into the next strategy. Now friends, we'll talk about this new strategy which is called the straddle. Now initially when we are doing the bull spread and bear spread, we were basically betting on the stock going up or down. Now what if we do not want to bet on the direction? We just want to bet on the volatility, that the volatility either is going to go up or it is going to come down, right? Now in that case, this strategy that we may apply is the straddle. Now how do we apply the straddle? We choose an option, both put and call, of the same price, which is typically an at the money price, and we buy both or sell both. This is what straddle is. So let's say a stock is at time 0 at a price of $100. Now when we enter a straddle, what we do is we either buy both a call and a put, buy a put and buy a call at the same strike price, that is $100 ATM at the money strike price. Or we may sell both, that is we sell an ATM put and an ATM call together. Sell a put, sell a call, which are both ATM together, right? They have the same strike price and the same expiry, typically speaking. Now when we are buying both, it is called a long straddle, and we are selling both, it is called a short straddle. Now what is the initial cash flows? What is the expiry value? What is the profit and loss? What is the break-even price? What is the max loss and max gain? In both the cases, we'll try to understand that. But first, we have to understand, if we do not have a view in direction, then why do you want to get into an option strategy? The reason is we want to bet on the volatility, right? When we are predicting that the volatility is going to go up, then we are going long straddle. Long straddle means long volatility, and short straddle means short volatility. We are predicting that the volatility is going to come down. And how this pays off? Let's say at t is equal to 0, one buys a put and a call at the money. So P0 and C0 both have been bought, so they are cash flows which have gone out. Now if the price goes high on any of the directions, what happens is, let's say the price goes up very, very high. Let's say it goes up to 120. Now here the call gets activated, that is the call option can be exercised. So there is a gain of $20 here, right? Because the strike price is $100. So there is a gain of $20 on the call option, and we can obviously reduce it by the premiums paid, P0 and C0. This can happen. If it comes down, let's say it went to $80, the price went to $80. In that case also there is a gain of $20 because both the options have been bought. They are all rights, not obligations. So we subtract the premium to get the net income or net profit if the volatility is high. Here the volatility, remember, has to be high because we are paying both the premiums. So let's say if the premium is $5 for the put and $3 for the call, there is an outward cash flow of $8. So minimum 8% volatility has to be there for break even to happen, right? It was $100, the price of the stock was $100. It has to at least fall to $92 or at least rise to $108 for this strategy to reach break even. So when we are going long straddle, we are actually betting on high volatility, which means on either direction the stock price will move in large amounts. That is what the speculation is. Now, what happens in case of short volatility? Let's say we sell both the options, that is at t is equal to 0. At t is equal to 0, there is a cash inflow of P0 and a cash inflow of C0. But both of them are obligations because we have sold the option. Now the price initially was, let's say, $100. Now at expiry, that is t is equal to capital T, let's say, the price went up to $120. In that case, the put option expires without value, but the call option is exercised. And because of 20% change in the price, because of high volatility, there can be a loss. But what if the price only changed 2% or 3%? Let's say the price changed from $100 to $102. $100 to $102. In that case, what happens is, the net loss is $2 and the net gain is the premiums of both the put and the call. Let's say again, the premiums are $5 and $3. So here the profit is minus $2 plus $8. So a net of plus $6, right? This is what happens when the volatility is low and we are short volatility through a short straddle. Now these are the strategies we have briefed before. Now we are going to generalize it and put into values. What is the expiration value? What is the profit and loss? What is the initial cash flows? What is the break-even price, max loss and max gain? Let's do it one by one. Let me remove the rough work first. So first let us look at the long straddle. The initial cash flows are minus P0 and minus C0 because we have bought both the option at time 0, right? And both of them are ATM, right? So we have paid high premiums for both. So we need high volatility to make up for this, as I have said before. Now at expiry, what is the value? Both the options have been bought. So the value is max of 0 ST minus X plus max of 0 comma X minus ST. Either the call will become valid or the put will become valid or exercisable. In either case, there will be a gain, but the gain has to be substantial to make up for the premium payments which have been made at time 0, right? So this is the value at expiration. Now what is the profit and loss? The profit and loss is the expiration value adjusted for the initial cash flow. So this is equal to plus max 0 comma ST minus X plus max of 0 for X minus ST. Remember, the first one is for the call and the second one is for the put, minus P0 minus C0, right? These are the initial premium payments. This is the profit and loss at expiry. Now what is the break-even price, friends? Now in our example we saw that $100 stock is there and we have paid a total premium of $5 and $3 for the put and the call. So price has to reach either 108 or it has to reach $92. So effectively there are two break-even prices, right? Two break-even prices. And the break-evens, how are they measured? They are measured by the strike price, which is equal to the initial stock price minus the premiums, sum of the premiums, and strike plus the sum of the premiums. These two are the break-even prices, right? So let me write it here. Strike price plus the sum of the premiums, and this is the first break-even, and the second one is strike minus the sum of the premiums. Premiums that are paid in this case, right? Now, what is the maximum loss? Maximum loss is equal to the total premiums paid. This is equal to sum of the premiums. Because both the options, if both the options expire without any value, that means only the cash outflow remains, which is the initial sum of premiums. What is the maximum gain? Maximum gain is unlimited. Maximum gain is unlimited. Let's say this stock price went to 150 at expiry. This means the total gain is 50 minus the sum of the premiums, which is $8. This is equal to 42. Now instead of 150, it can also go up to 200, right? In extraordinary cases, it can also go up to 200. In that case, the gain will be 100 minus the sum of the premiums. 100, why? Because the strike is 100, so 200 minus 100 is 100. 100 minus 8. This is the total gain when the price moves to 200. That is 100 above the strike price, right? When it goes down also, it is substantial. The gain potential is substantial. Let's say, let me remove this here. Let's say the stock price went to 50. In that case, the gain is from the put. Initially the gain was from the call, now the gain is from the put. Here the gain is plus 50 minus 8 right? Let's say the stock price goes to 0. Here the gain is full 100 minus 8, right? So in case the stock price keeps moving upwards, the gain can be literally unlimited, and if it keeps going downwards, it is substantial till the price falls to 0, right? Limited to the price of 0 on the lower side. So unlimited or unlimited on the upside and equal to the strike price minus the sum of the premiums on the lower side, right? This is how the max gain happens. Now the same thing we can calculate for a short straddle also. In case of a short straddle, what we said is we are going to sell an ATM put and we are also going to sell an ATM call. So the initial cash flows are plus P0 and plus C0. So if in our example the premiums are $5 for the put and $3 for the call, the total cash flow is positive $8 at t is equal to 0, right? Now what is the value at expiration? We have sold both of them. So minus of max, for the call option it will be 0, st minus x, and minus max. For the put option it will also be 0, x minus st. This is the expiration value at t is equal to t or t is equal to expiry. What is the profit and loss? The profit or loss is equal to the initial cash flows adjusted for the final cash flows minus max of 0, st minus x minus max of 0, x minus st. What is the break-even price? Now the break-even price here is also twofold. Let's say the initial price was 100, right? Let's say the stock price falls to 92. Let's say the stock price falls to 92. What happens? The put gets exercised, the call goes out of value, right? So the put get exercised, so the loss from that is minus 8 and the initial cash flow is plus 8. So this becomes 0. And also let's say it goes up to 108. In that case, the put expires without value but the call gets exercised. In that case also the loss is minus 8 and the initial cash flow is 8. So this is equal to 0. So here also the break even is defined in the same way. This is equal to strike plus the sum of the premiums. This is one break even price, the upside break even price, and the downside break even price is x minus the sum of the premiums. That's how this works. What is the maximum loss? Now in this case the maximum loss can be unlimited if it's on the upside. On the upside it can be unlimited. Let's say the stock price instead of 108, the price was 100, instead of 108 it went to 150. The loss is minus 50 plus 8. If it goes up to 200, the loss is minus 100 plus 8. Like this it goes on. And on the bottom side it can go up to 50. In that case also the loss is minus 50 plus 8. If it goes to 0, if the stock price goes to 0, in that case also here the put is getting exercised. In that case also the loss is minus 100 plus 8. So on the upside it is literally unlimited. On the downside it is equal to the expiry, maximum equal to the expiry. Expiry minus the premiums. On the downside it is x minus the sum of the premiums. What is the maximum gain? The maximum gain is equal to P0 plus C0. P0 plus C0. The main intention is both the options should expire without getting exercised. Both the options should expire without getting exercised. So ideally the stock price should remain at 100. It should not move. Volatility should be literally 0. But let's say it moves a little bit. It moves to say, let's say $102. In that case also the loss is minus $2 but the gain still remains to be $8. So the net gain is plus $6, right? Maximum gain happens when volatility is absolutely 0. That is the stock price does not even change. So this is how straddle occurs. When you are short volatility, you are short straddle. When you are long volatility, you are long straddle. And the max gain, max loss, break-even price, expiry value, profit and loss are all explained here. Now friends, we begin our next strategy analysis, which is called the collar strategy. Now what do we mean by a collar strategy? Let's explore this. Let's say at t is equal to 0, the price of a stock is $100. It's $100, okay? Now let's say the trader believes that the price is going to go up moderately. What do we mean by moderately? Let's say the trader thinks that the stock price is going to go up till $110, right? It will remain within the range of 100, 110. And even if it comes down, it will not come down speculatively below $90. Within the trading window that the trader has in mind, this is going to be the situation that the price is going to move up towards $110, not beyond it. It will be within the range of 100 and 110. And even if the stock price comes down, it will not come down below $90. This is the speculative position that this trader is trying to take. And in this situation, the collar strategy becomes very, very suitable. Now, what is the collar strategy? Now, I am going to write down the positions first. So, what is the long collar comprised of? It is comprised of 3 positions. Position number 1 is long the stock. Long the stock, which means we are having a long view or upside view on the stock. Second is buying a put. Buying a put is basically getting protection against the downside movement beyond a certain point, right? And the third position is selling a call. Selling a call. This means this speculation is moderate upside, moderate or range bound upside. So as we took the example here, let's say right now the price is 100, we go long there and we sell the call. We sell the call at a strike price of $110 and we buy the put. We buy the put. This is negative sign, means we are paying the premium in case of the put at a strike price of $90. This was our example, right? Now based on this, we are going to generalize it. Now the first question is, what is the initial cash outlay? So the initial cash outlay CF0 is equal to long stock, means there is negative cash outflow, minus S at time 0 or minus S0. Selling the call, which means plus C, and buying the put, which means minus P. This is the initial cash outlay. Now what is the value at expiration? Value at expiration is equal to price of the stock at expiry plus value of the option, value of the put at expiry, that is max of 0 and ST minus X, minus value of the call at expiration 0 comma X minus ST, right? Now this X is XC, the call strike price, and the previous one is the put strike price or XP, right? So let me write here XP and XC. These are two different strike prices on either side of the current price of the stock, right? And this S, you can say this is the S0, this $100, this is the S0, right? So this is the initial cash outlay CF0 and the expiration value we have mentioned here. Now the question is, what is the profit or loss at T? This can be easily calculated, friends. Let me just do one thing. Let me remove this example portion downward so that I have some space. Now the profit and loss is nothing but CF0 and CFT, cash flow at time T. Now this is equal to CF0 is minus S0 plus C minus P, and cash flow at time T is the expiration value. This is equal to plus ST plus max of the put value, that is 0 comma ST minus XP, minus value of the call option max of 0 XC minus ST. this is the profit or loss at time t. What is the break-even price, friends? The break-even price is the initial price of the stock plus the cash outflow or inflow due to the premiums, right? So this is equal to, break-even price is equal to S0 plus the difference in the premiums. Now if this difference is negative, the break-even price will be lesser than S0. If this premium difference is positive, the break-even price will be greater than S0, right? Maximum loss. Now maximum loss happens when the price falls below $90. So when ST is less than equal to 90, that is when the maximum loss occurs. Now what is that loss amount, friends? That is nothing but the difference in the prices plus the difference in the premiums plus the value of the call minus the value of the put. Why minus the value of the put? Because the put is actually reducing the losses. By buying the put, there is protection below $90, right? In our example, there is protection below $90, so this is reducing the losses. So this is how it goes. But the value of the call is 0, so we erase it. The value of the call is 0 because the price is nowhere near 110. It has gone, in fact, it has gone beyond below 90, right? So this is the way it occurs. Now in our example, let's say the price went to $80. This means what? From the stock price, the loss is $20, right? $20 loss due to the stock purchase. Then the premium, let's say the call premium was $3 plus $3. The put premium was $5 minus $5, and the put option gave a gain of $10. So this is minus $10, right? The put is reducing the losses here. So this net to net becomes a total value of 23 minus 15. This is equal to $8 loss, or you can write it minus $8 of profit, right? The maximum gain occurs when the stock price hits $110, but does not go beyond it. It hits exactly $110. Now in that case, there is gain due to the gain in the stock price. Then the premium is adjusted. It can be positive or negative premium. Generally it's a negative premium, so I am including the value here or the sign here. The value of the call and the value of the put both are 0 at 110 strike, right? So both of them expire at 0 value. So the maximum profit is this, the difference between the premiums and the gain due to the stock price increase. This is the maximum gain, right? And actually this is nothing but the call strike minus the price at which the stock was purchased plus the adjustment due to the premiums, right? This is the maximum gain. Now we have completed the long collar position. Now when does one enter a short collar position, and what are the positions taken there? Now we will do it with another example. Let me remove the rough work here. Friends, it is very difficult to remember the max loss, max gain, break even, expiration value, profit and loss of every position. So it is better that you know what are the fundamental reasons one is getting into those positions. Like in long collar, we have entered it because we think there is moderate upside, not too much, range bound upside, and we also want to protect the downside because beyond a certain point we do not think the stock is going to go down. We generally think the stock is going to go up. So from 100 we think it is going to go up to 110 at most, not beyond that, and chances of going down are less. Even if it goes down, it will not go down below 90. That is the kind of situation we want to get into a long collar in. Now the situation is just the reverse when we are entering a short collar. We are speculating that the stock is going to fall but not too much. So the positions are like this. Number 1, the position is short the stock. short the stock. Number 2, we think it is going to go down but not too much, so we want to sell the put. So we short the stock, let's say at 100, we sell the put, let's say at 90, because we think beyond 90 it will not go down. It will go down but it will stay above 90. And the third is buy the call. Buy the call, let's say at 110. 110 is the strike price for the call, 90 is the strike price for the put, and the stock price, let's say, is 100. This is in our example, right? The example that we have taken. Now, why are we doing this? We are doing this because we think the stock price is going to go down, so we short the stock, but then we think that it is going to go down but not too much, a little bit, so we sell the put. So we sell the put at 90, and we think that okay, chances of going up are not there, but in case it does beyond the point, we want to protect that, and also we want to make use of the premium that we have earned from selling the put, right? Now this is how short collar happens. Now in a short collar, the initial cash flow CF0 is equal to the premium paid by buying a call minus C, the premium earned by selling a put plus P, the earnings from shorting the stock plus S0, right? This is the initial cash flow. This is generally going to be an inflow, right? Now the value at expiration is nothing but the cash outlay to purchase the stock back at expiry, ST minus ST. That is at the expiry, let's say the price is ST and the shorted stock has to be purchased back, so there is a cash outlay of ST plus the value of the call that has been bought minus the value of the put that has been sold. So the value of the call and the put we can easily write here. Value of the call is max of 0, ST minus XC minus the value of the put, max of 0, XP minus ST, right? Now the profit and loss at time t is just the two cash outlays, CF0 and CFT. This is equal to, I can write it like this, the difference between the prices of the stocks, S0 minus ST, the difference between the premiums, minus C plus P, plus the value of the call minus the value of the put. So let me write down the values of the call and the put again here. So this is equal to plus max of 0 ST minus XC minus max of 0, XP minus ST, right? Now what is the break-even price? Now friends, the break-even price is just that price which is equal to the initial cash outlays, right? S0 minus the difference in premium. Now this cash outflow, generally speaking, tends to be positive, mildly positive, because for the same moneyness the put is having a higher premium than the call, right? So there is a positive premium here. On the other hand, if there is a cash outflow, then the formula will be S0 plus the difference between the premiums, in case there has been a cash outflow. Then now what is the maximum loss? The maximum loss happens when the stock price goes above the higher strike price. That is, in our example, it is 110. If the price goes above and beyond 110, then the question of maximum loss comes, right? Now in that case, the maximum loss is equal to the difference between the stock price adjusted for the difference in premium. I am writing minus here because it can be positive. If it is negative, the sign will become plus. I am writing here minus. Then value of the call minus the value of the put. Now if the price has gone beyond 110, obviously the put value has become 0, so we remove it. The value of the call remains there. So value of the call will be equal to max of 0 comma st minus xc. Remember, this is the loss. This is the loss amount, right? And the loss amount is made less a little bit if the premium is positive. If the premium is negative, then it will become negative. So let me do one thing. Let me write it as plus. The sign remains within the difference here. If it is negative, the loss is reduced. If it is positive, the loss is augmented, right? Now, what is the maximum gain? The maximum gain happens when the stock price hits the lower strike price, that is the put strike price. So when the price hits $90, that is when the maximum gain happens. And if it goes to 91, the gain is reduced. Remember, it has to exactly hit 90. At that price, there is maximum gain. And the maximum gain is equal to S0 minus XP. That is the difference between the strike price and the initial stock price at which the stock was shorted, plus the difference in premiums, right? Now, when we are writing the difference here, we are actually incorporating the sign also within this del value, because if it is negative, the gain is reduced. If it is positive, the gain is increased, right?
Understanding how the concepts of CFA are applied practically by professionals and learning artificial intelligence and its applications in finance can really help you grow in your career. Check out the link below for more.
So friends, now we come to the calendar spread, the next option strategy. Now, the word calendar spread itself is talking about timelines, right? So this is a strategy which tries to take advantage of a speculated timeline. Provided the speculation goes right, the strategy should work, right? So there are two kinds of strategies in this. There is a short calendar and there is a long calendar. So a short calendar spread and a long calendar spread. So when do we get into either of them and what can be the payoffs? This is what we try to understand. So when do we get into a long calendar spread and when do we get into a short calendar spread? Let's understand that. Let's say there is a stock XYZ which is right now priced at $100. There are two options. One is expiring in 1 month and another is expiring in 3 months, let's say. Now, an investor has a speculation that for the next 1 month, the prices are going to be stable. That is, it is going to be very much around $100. And after 1 month, there is a quarterly result and the quarterly results are expected to be very good, right? And the investor feels that post this, the price is going to spike up for the next 1 or 2 months, right? Next 1 or 2 months, the prices are going to be higher. Now, in this kind of a scenario, the investor can get into a calendar spread to take advantage of this kind of a situation. So let's say the investor is projecting this, that right now the price is $100. Maybe in 1 month it will be somewhere around $101 or $99. It can be either. And at the end of 3 months, the price can be, let's say, $115 or $110, right? So there is a kind of a price appreciation that is being projected here. Now, the investor decides that the investor is going to sell a 1 month call option and buy a 3 month call option, right? So sell a 1 month call option and buy a 3 month call option. Let me write it here. Sell 1 month call and buy 3 month call. Now 3 month call buy we can understand, and remember the selling price and the buying price in this example is at the money. So let's say the strike price is $100 itself, right? So the strike price is $100 itself. So at the money sell of a 1 month call option and at the money buy of a 3 month call option. Now the buying of a 3 month call option we understand here, right? Because we think that at the end of 3 months the price is going to be $110 and we are buying the option at only $100 and we feel this is going to be the payout. The difference is going to be the payout. So we are buying it. But why we are selling this 1 month call option? This is the question. The reason is by selling the call option we are actually earning a premium here, right? So let's say the 3 month call option has a premium of $5. it has a premium of $5. And the 1 month call option has a premium of $2. Right? Now, if the speculation is correct and the price ends up to be $110 at the end of 3 months, then the payoff without the sold call option will be only $5, right? Because 100 is the stock's price, 5 is the premium, and the price appreciation is $110. But if there is a sold call, then there is a premium reduction effectively here. We get a minus $2 here. So the actual cash outflow is 100 plus $3, which is $103, and the payout is $110. Remember, this is taking into assumption that both the speculations are correct. That is, for 1 month the prices remain stable, and on the 3rd month the prices do reach to $110. Then these are the payouts. Okay. So here what we are trying to do is, by selling the call option, we are taking the advantage, or we are trying to take the advantage of the low volatility in the near term and trying to reduce our premium cost by earning some premium. That is what is happening here. Now, let me tell you, this long calendar can also be done with respect to a put. So let's take another example here. Let's reverse our speculations in terms of direction. Let's say the same thing is happening. The quarterly results are going to come, and the speculation is the results are going to be not that good. So what the investor thinks is the prices are going to move stably for 1 month and then go downwards. So let's say the investor predicts that it is going to go down to $90. Then what can happen? What can happen in this case is the investor sells a put which is 1 month to expiry, and ATM, which means at the money, strike price of $100. This is sold. This is 1 month expiry put which is sold, and a 3 month put is bought. A 3 month put, again an ATM put, is purchased. Okay, let's say the premium for the sold put option is $3 and premium for the bought put option is $6. Now, if the speculations are correct, what happens is at the end of 3 months, the stock price reaches $90. And what is the payout, friends? The payout is 100 minus 90, which is $10. This is the gross payout minus the net premium, that is 6 minus 3. The payout is again $7, right? So here again, both the speculations, here it is assumed that both the speculations are going to be correct. In that case, there is an earning of $7. So a long calendar spread does not mean, let me rewind once again, a long calendar spread does not mean you are buying only a call option. A long calendar spread does not mean you are only buying a call option. It can also entail buying a put option. A long calendar spread does not mean you are only buying a call option. It can also entail buying a put option. Only thing is, you are selling the short term and you are buying the long term. Long calendar spread buys the long term. Long calendar spread buys the long term. That means the short calendar spread does the opposite. Short calendar spread sells the long term. So let me take an example of a short calendar spread. Then we'll write the theory part. Just take an example first. Okay. So let's say once again, the stock is XYZ. Let me write XYZ here. The stock is XYZ. The price is again $100. There is 1 month option. There is an option which is expiring at 1 month and again an option expiring at 3 months, right? Now, the investor is looking to take advantage of recent movements. Let's say recently some merger has been announced. Some merger and acquisition has been announced, and which is going to be synergistic and beneficial to this company. So therefore, the investor predicts that the stock price is going to move upwards in the immediate term, at least in the next 1 month, right? So what the investor wants to do is buy the short term option. In this case, this is a call option because the investor is predicting there is going to be a price spike. And In the long term, the investor feels that the price after, let's say for 1 month, it will rise, and then again this market effect will subside and the prices will become stable. So the prices will move up for 1 month and then again become stable, right? So what the investor does is, to reduce the premium costs of this 1 month option, net premium cost, the investor sells an option which is 3 months to expiry. So this is selling the long term option or the 3 month option. Here in this case, because we are speculating a price rise, both are call options, and both once again are ATM options. That means the strike price in our example in both the cases is $100. Okay. So in the long term there is price stability, in the short term there is price spike. So one goes for call option purchase in the short term and selling long term call option. Now what if there is a sudden price reduction which is projected? Then the same thing is done with the help of put options. So let's say 1 month one is speculating that let's say the quarterly results have been bad, or let's say some key managerial person has resigned, and because of that there is going to be a price reduction for the next month, and then again let's say the market effect will subside and the prices will become stable. So prices may be going down and then becoming stable. After 1 month it will become stable. So based on these kind of projection, buying a short term put and selling a long term put can work. Now once again, buying a short term put is very apparent because one is betting on the price going down. And why the long term put selling? Because through selling of the long term put, one can take advantage of the price stability after 1 month to reduce the current premium costs. Right? And this kind of a method is called a short calendar. So short calendar sells the long term. So you can think this strategy in terms of the long term. If one is buying the long term option, then it is a long calendar. If one is selling the long term option, then it is a short calendar. So let me write the theory part here. So a long calendar means there is stability in the short term and volatility on either direction in the long term, which means one sells the short term option because there is low volatility, and one buys the long term option because there is high volatility. Now the reverse thing happens in case of short calendar, where volatility is there in the short term. The higher volatility is in the short term. So one buys the short term and there is stability in the long term, which means one sells the long term, right? So once again, if there is stability for 1 month projected, and after that there is a 2 month of volatility projected, so 1 month of stability and 2 months of volatility projected, then one goes long term calendar or long calendar. Right? And if there is volatility projected in the short term and stability projected in the long term, that is 1 month prices will be volatile, then it will stabilize, then one goes short calendar, right? And the basis of this kind of a strategy is the time decay of options. If one looks at the graph of a time decay, let me show you one. So here is the time decay curve. The time value is the vertical axis. This is the time value of the option, and the time is on the horizontal axis. Now you can see the ATM option, the closer is the date to expiry, the faster is the value reducing. You can see here the slant is very steep. So this is what is being taken advantage of in either of the cases. The value is diminishing of the option when it is a nearer term option, and this is being taken advantage of to make profit in a calendar sprint, right? So let's say the curve looks like this, and the 1 month expiry has a steep slope like this, right? 1 month expiry has a steep slope like this, and then it is stable for 2 months. I'm just taking an example here, right? So compared to the premium, so the longer term option has higher value. The longer term option has higher value than the short-term option, right? And because of this very precise reason, it is a little bit more difficult to benefit out of a short calendar, because in the short calendar segment, you are actually playing on this higher slope of theta, right? You are buying this one. So there is a drastic drop in value, time value, and the price change has to make up for it, and more than make up for it, for you to make profits. And that's why the short calendar is a little bit more trickier and more difficult to make profits from. So this is about the calendar. Now we'll move into the next segment where we'll talk about volatility. Implied volatility, volatility skew, and volatility smile. What do we understand by all this? So friends, let's say at a certain period of time, t is equal to 0, we have a stock which is priced at $100. Now, for this stock, we are going to look at a series of option prices, option premiums and their prices for the same expiry. Let's say expiry of 3 months. Let's say a series of call options we are trying to understand. So the first call option that we look at is the ATM call options, C100. We are trying to understand its premium. I'll write the premium numbers later, but let me write the series of options that we are looking at. First, we are looking at the ATM option, which is the call option at 100 strike, 3 months expiry. Then we are looking at call of 110, again 3 months expiry. Then we are looking at call of 120, again 3 months expiry. Then we are looking at 130 call option, again 3 months expiry, like this, 140, 150. So we're looking at these 6 call options, okay? Now, let's say the premium for the ATM call option for a 3-month expiry right now is $10. For 110, visibly it will be lower because 110 strike call option is out of money currently. So it will have a lesser price. So let's say the price is $8. The 120, this one, let's say has a premium of $6. 130, $4. 140, $2. 150, $1. Let's say. These are the premiums for the respective call options. Now, let us look at the put options which are out of money. So let's say first we look at strike 100 put option, 3 months expiry. Then we look at strike 90 put option, again 3 months expiry. Then we look at strike 80 put option, again 3 months expiry. Then strike 70 put option, strike 60 put option, and strike 50 put option. Obviously, other than the 100 strike put option, everyone else is out of money, right? Because if the strike price is 90, current price is $100, which means this put option is out of money. Like this, it goes for all the other put options. Now, our common sense tends to say that these have the same degree of moneyness. Like the call 100 and the put 100 have the same moneyness. They are both at the money, right? So they will have the same premium. And we may find that they have the same premium. They actually have the same premium at t is equal to 0, right? Then we move into the call 110 and put 90. Now, mathematically speaking, they are also having the same moneyness, right? From the strike, both have a distance of $10. Both are out of money by $10. So they should also have the same premium. But herein lies the observation that interests us, that often it so happens that the put premium is higher than the call premium for the same level of moneyness, specifically for the out of money options. So here the put premium, we may find it is not $8, it is more, it is $9. Same goes for the rest of the series. So the call 120 is $6. Here we may find that it is not $6, it is actually $8. P70 is not $4, it is instead $6. P60, let's say, is $5. P50 is $4. So you can see, if you compare with them, $2, $5. Obviously $5 is more. $1, $4. Obviously $4 is more. So this is how this thing plays out. Okay. Now we can plot this in a single chart, and the chart that we'll have will be called a volatility skew. Why? Let me tell you. Now on this vertical axis, we represent the volatility or the implied volatility from the premium, and this is the moneyness axis. Okay. So this is the strike price, which is 100. On the right hand side, let me write down 110, 120, 130. Okay, we'll have to extend it. $140, $150, $100. Okay, $150. Okay, let me write $160 here. Then on the left hand side, we have 90. Then we have 80. Then we have 70. Then we have 60. Then 50. Right? These are the put option strikes, and these are the call option strikes. These are the put option strikes, these are the call option strikes. So let me write it XP and XC. Now on this vertical axis, we represent the volatility or the implied volatility from the premium. So in Black-Scholes equation, the premium is decided based on the expiry and assuming that the volatility across the expiry is going to be constant. So here let's say the $10 premium for the ATM options for both put and call represents 20% volatility. Okay. So let me plot it here. 10, 20, I'll write the numbers also. 30, 40, 50, 60, 70, 80. These are the volatility numbers assumed. 30, 40, 50, 60, 70, 80. So these are the calibrated numbers in the vertical axis which represent nothing but volatility. And the premium calculation is done here based on the Black-Scholes equation we are assuming, right? Therefore, if we have to plot the volatilities along the vertical axis with respect to the strike prices on the horizontal axis, first if we consider the call strikes, what can happen is for the ATM option, the volatility assumed is, let's say, 20%. For both put and call, it is 20%. Okay, let me change the color here. This is the point, right? Now the 110 call, this is assuming a volatility based on the premium of $8. Let's say this is assuming a volatility of 18%. So it will be somewhere here. Then the 120 strike call based on the $6 premium and 3-month expiry is assuming a volatility of, let's say, 15%. The 130 strike call based on a $4 premium, let's say they're assuming a volatility of 14%. Okay. These are just assumed numbers. I have not solved the equation here, right? So like this, let's say the 140 strike call assumes 12% and the 150 strike call assumes 10%. Right? Now this is how the curve goes. On the call side, this is how the points look like. But the scene is very, very different if we look at the put option premiums. If we look at the put option premiums, maybe the 90 strike put with a premium of $9 is actually assuming a 22% volatility. The point may lie somewhere here, right? Between 20 and 30 somewhere. Okay. Now the 70 strike put with $6 premium, let's say they're assuming a volatility of 30%. So this will come somewhere here. Okay. Like this, the 60 strike put and the 50 strike put are assuming, let's say, 35% and 40% volatilities. So the points will be somewhere here, and for the 50 strike it will be somewhere here, right? So what you can see here is a slanted line on one side, right? If I draw a line along these points, it looks something like this, right? Now you can see it is not symmetrical on either side. It is skewed. So that's why this chart is called a volatility skew. Let me write it here. Volatility skew. And we are looking at a single snapshot of time, right? At t is equal to 0 right now. At t is equal to 0, the strike price is this, the stock price is this, and these are the range of premiums, and we are looking at the respective implied volatilities, and we are trying to draw a curve out of it. That curve is being called the volatility skew curve, and the vertical axis here is represented by the volatility, implied volatility. Implied volatility, implied from Black-Scholes equation in this case, considering volatility to be constant till expiry, right? So these are important because in practical scenarios many variations happen, but while calculating, obviously this becomes useful, because if the calculation is saying that volatility is going to remain constant at let's say 20%, and if the investor thinks that the volatility is going to increase to 30%, then there is a option to trade, right? So this is how the volatility skew works out, right? And trade options are also decided based on this, that the implied volatility, what it is saying, and what is actual ground reality saying. If the actual ground reality is different, then there is a scope of trade. Now let's say at t is equal to 0, most of the investors are predicting that even after 3 months, the curve would look something like this only. That is, right now t is equal to 0, and we are looking at 3-month expiry options, and the curve is like this. Now most investors thinks that after 3 months also the curve would look something like this. So at t is equal to 3 also, the curve will remain the same. That is, the premiums will be skewed. Now let's say at t is equal to 3, this curve fructifies to be like this only. The projected premiums actually remain the same even at the expiry. Now there is no trading option. But let's say the market sentiments have started to improve and few investors have gauged it, and they have projected that at t is equal to 6, the curve would look something like this. The premiums for out of money call options will rise because of higher volatility on the positive side. Now this makes for a trade, right? And this trade can be made at t is equal to 3. So the projection can be that the premiums are going to rise, and it can be an opportunity in terms of buying at a lower premium and selling at a higher premium. It can be an opportunity based on buying at a call option at a strike which is much lower than the actual price of the stock at expiry. Both can be the cases, right? So this is the opportunity that volatility skew provides. Now the second curve at t is equal to 6 is symmetrical, right? Let's say if it fructifies, then this becomes what is called a volatility smile. This represents volatility smile. So if the curve is showing a smile and the projection is a skew, then there is a trading opportunity. If the curve is showing a skew and the projection is that of a smile, then also there is a trading opportunity, and herein lies the significance of volatility skew and volatility smile. So let me write it in short above so that we remember how the things are. This is volatility smile. That for the same moneyness, for out of money options, both call options and put options, the premiums are symmetrically distributed, right? This is the volatility, and here we have the strike prices, this is the ATM strike price, and here out of money calls, and on the left hand side out of money puts. Now this same thing, if this curve becomes skewed in favor of higher volatility towards out of money put options, then that becomes a volatility skew. This is a volatility skew. So this is an overview of volatility skew, volatility smile, and the relation of implied volatility with this, and what are the trading opportunities they offer, right? We have had an overview of this. Now friends, one thing we fixed here is the time. This curve represents one moment, one snapshot. Maybe today is a trading day. Today's what is the curve? That is what it is representing. Now, what if we make the time also dynamic? Then it becomes a volatility surface. Then it becomes a volatility surface. Now it can look something like this. This is the volatility surface, my friends. And what it is showing, let's understand. This axis is the moneyness, right? This is the moneyness axis, and this point, let's say, is the strike price. Okay, so this is representing the at the money option position. So here the curves are meeting, and if you actually try to put a two-dimensional figure on it, if you actually want to see it in two dimensions, this looks something like this. Let me show you. The first layer, if you just slice a narrow part of it like this, and we want to see it front face, how will it look like? This will look something like this in 2D. And if we just rotate it a little bit, we can see the plane, and it looks something like this, right? This is the time axis, right? So here, this is the time axis. Okay friends, so this is how this looks like. Here we have extended the time axis also. We are not looking at only one moment of time. We are looking at the futures also, future moments of time also, and projecting it in that way. And in this way, the shape of the skew can become a smile, the smile can become a skew, and it can change accordingly, right? And the degrees of the skewness, degrees of the symmetry can change. All of these things can happen across time, right? Now when the time is changing, what is actually changing here? The implied volatility across time is changing. The implied volatility across time is changing. Investment objectives and strategy selection. So there are three features to consider while selecting a strategy. First is the direction of the movement of underlying. Whether the investor has a view of it. If the view is there, what is the view? If the view is not there, then the second point comes, which is what is the view in terms of volatility. Let's say we do not know if the price is going to go up or down, but we have a speculation that the price is going to change drastically either direction. That means we are projecting higher volatility. If we say that the prices are going to be stable, what we mean is not only that the direction of the price is not very drastic, it also means that the volatility is going to be low, right? Then perception of other investors about the volatility of underlying. So when the investor is making a speculation about the market's volatility and the direction, the investor also has to take into account the response of other investors to the current markets. So while making a conclusion about the direction and volatility, what others think, that also needs to be incorporated in that projection. And based on this, the opinion needs to be made, right? So let's say if the investor thinks that most of the investors think the market is going to go up, but that investor, that particular investor who is speculating is of the opinion that the market is going to revert. That is, there is going to be a contraction in the markets in the next 3 to 6 months. While the entire markets is of the opinion that there is further upside to the market. In that kind of a situation, there can be a trade. On the other hand, let's say a contraction phase is continuing for last 6 months or 1 year or 1.5 years, and everybody is thinking, most of the people are thinking for the next 3 months also, the prices are going to go downwards. On the other hand, few investors realize that the market has bottomed out or almost bottomed out, and is in the next 3 to 6 months they are going to reverse. Now in that case also there is a trade to be made. It depends on the degree of conviction that that opinion has, right? It depends on the degree of conviction. Now, going beyond delta, obviously call and put change with the change in underlying, and the change is not perfect, that is, it is less than 1, but that change is represented by delta. It can be 0.5, which means if the underlying changes $1, the option changes $0.50. It can be 0.8, which means if the underlying changes $1, the option changes $0.8, like this. But beyond that, there are second degree derivatives also, like gamma, and there are other Greeks also, like theta and vega, which determine the profitability of an option. A large amount of volatility can impact the vega, which can itself change the value of the option. Theta also can change the value of the option and can lead to losses despite the stock ending above the strike price. Why? Because the impact of time on options is always negative. The degree has to be different. If the theta decay is more than the rise in price, then there will be a loss even when the price actually rose above the stock price, right? Now, a few advantages of derivatives. So while trading, one has to look into all these options. One has to look into all these factors and then make a decision on the direction of the trade, on the nature of the trade, and whether the trade should be made or not. Now we'll talk about a few advantages of derivatives. Now derivatives help in speculation. Obviously we spoke about that. They help in hedging. Investors or institutional investors or even individual investors can hedge their bets with the help of derivatives. Then there is leverage. One can pay just 10% margin and take an exposure in the derivative. Liquidity. Underlyings can be less liquid than the derivatives, which can actually benefit the derivatives in terms of liquidity, right? The same directional movements or the same volatilities can be taken advantage of with higher degree of liquidity than the underlying, right? So these are the few advantages of derivatives. Now, based on the view of the volatility and based on the view of direction, which also incorporates the reaction of other participants in the market. For an investor, when the investor is trying to make an opinion on the direction and the volatility, that opinion includes the response of other market participants. So one may think that, okay, prices are going to rise because the stock is doing well. No, that is not the only conclusion. The stock is doing well, people will notice it, they will buy the stock more, and the price of the stock will rise. On the same thing, that the investor may, on the same front, the investor might think the position has to be entered as early as possible because option traders may also notice it and raise the premiums. So all these equations, all these considerations are included within that trade. The consideration of other investors, other traders are also included within that trade. Basic strategies. Directional view and volatility view, both are included here. Now in terms of direction, we are considering bearish, that is the price is going to go down. Stable means prices are going to remain stable. Bullish means prices are going to go up. And in terms of volatility opinions, there is rising volatility opinion, stable volatility opinion, falling volatility opinion. Now combining all this, for example, let's say if the volatility is rising and the markets or the opinion in terms of direction is bearish, one can buy put. Right? On the other hand, if the implied volatility is rising and the opinion is bullish, then one can buy call. Like this, all these situations, all this combination of situation we'll discuss one by one, right? Now let's say a trader does not have an opinion on the direction, but the trader thinks that the volatility is going to rise. That is, either the price will go up drastically or down drastically. In that case, one can enter into a long straddle, right? Long straddle. Long straddle means buy both the put and the call. So here one thing is very, very clear. When the volatility is rising, one buys put. So which means when the volatility is falling, one sells the options. So when volatility is falling and the trend seems to be bearish, one sells a call. Selling the call means one is bearish on the stock and also bearish on the implied volatility. Now, if volatility is projected to fall and stock price is going to go up mildly, then what is to be done? Sell the put. Selling a put is bullish in terms of direction and bearish in terms of volatility, right? Then both direction and volatility are going to remain stable. Then one can enter a calendar spread, right? If the stability is in the long term and volatility is in the short term, then one goes short calendar. If the stability is in the short term and volatility is in the long term, then one goes long calendar, right? Then volatility falling, direction view stable. What does one do? One sells a straddle, sells or shorts a straddle. Means one sells a put option and a call option both at the money or near the money, right? With the same expiry. Then volatility is stable and view is bearish. In this case, one can write the call and buy the puts. So buying the puts because of the view of bearishness and because there is going to be less volatility, the payouts can be less. The payouts can be less. So to make up for that, write a call and earn a little bit of premium to enhance the returns, right? Then if the view is bullish but the volatility is stable, that is the prices are going to increase but not that much. So to make up for the less amount of rise in price or less payout, so one writes a put along with buying a call. So in this case, buy a call and enhance your return by writing a put, right? So just to rewind, why one is writing the call and the put in case of stable volatility? Because the premiums may take up much of the payouts. So to make up for that, we earn a little extra premium upfront by writing the call or writing the put, right? When do we write the put? When we are bullish. We write the call when we are bearish. So friends, thank you so much. So thank you so much friends for being with me in this class. See you in the next one.
Thank you so much, friends, for being with me in this class. If you found this class valuable, please like the video and subscribe to the channel. Share your feedback in the comment section below and share this class with a friend who may find this helpful. And once again, if you want support regarding your CFA exams, if you want to know how to practically apply these concepts, and if you want to learn artificial intelligence and its application in finance, please check out the link below. See you in the next class. Thank you so much.